So, all right, everyone in the class, I guess we are live. Everyone. Very good morning. Welcome to the session. Welcome to this amazing, full English detailed revision for the chapter of derivatives and interest rate risk management. Yes. So, guys, in this video, we gonna do almost all the concepts of the topic of derivatives, right? And also do at least one question of each type to make sure that this revision not only gives you the conceptual clarity but also the application of those concepts to the practical questions. Yes. So very welcome again. Who all do we have in the live class today? Come on. Very good morning, people. Say something in the chat box so that I can see who all do we have. Please mark your present. Mark your presence. Praveen, I can see is here. Then Navya. Navya, is that the name I should be taking? Soumya. Mr. Sky, what's your good name? Very good morning, people, everyone. What's up? Is everything all good? So, after this revision session, you all will have a good comfort, a holistic view, overall command and confidence on the chapter of derivatives. Before we start, those who are watching recordings, if you have not subscribed to the channel yet, kindly do subscribe, okay, so that similar revision video you get to be aware about, and obviously do like the video. That's for my motivation. Yes. So great. Shall we all with that get started, everyone? So before I start, let me tell you, we have two notes that we're gonna refer in this video. One is the concepts notes, calling them to be out notes. Another is out scanner, which is the question bank. Fine. Link of both of these notes I will give in the description of this video. Fine. So first thing. Second, we have also come up with the file called as new question by ICI, right? And we also have recorded a video for that particular thing, which has compilation of all new questions asked by the institute in the past few attempts in its RTP MTP exam paper. So link to that video is also there in the description. Fine. So now let's get started. Fine. Sir, let me show you how the outnotes look like. These are, everyone in the class, your out notes, the concepts notes for the subject of derivatives. These are the same notes that we use for a regular batch student, right? All the batches, the same notes are being used. So let's get started. Very good morning, Jai. Akash, very good morning. So I think we are all set to get started. Yes? Are you all ready? Everyone in the class, are you all ready to get started? Come on, please tell me. So, derivatives, if we talk about the chapter of derivatives, we will have to cover all these securities one by one, all these contracts one by one. We have to first learn about forward futures, then options, then FRA, IRF, IRO, and swaps. Done? Sir, what are these exact things? Don't worry about them right now. Let's get started. I will first of all give you a basic sense of how does a derivative contract look like. Yes, one important thing, very important thing in derivatives is to be able to understand the contract really well. Unless you know what a forward is, you cannot know further concepts related to forward. You cannot solve the questions based on forward. Right? Specifically in derivatives, try to understand what the contract is. Forward contract is exactly what? Sir, there are two parties. For example, one is you, one is me. You want to buy an asset, I want to sell an asset. Not now, but on a later date. You want to buy, I want to sell an asset, say after 3 months. So what do we do today? Today we enter into an agreement. Both of us enter into an agreement today to buy or sell. Say the asset is gold. So gold on which the contract is made will be called as underlying asset. right, which has been agreed upon to be bought and sold. Sir, we also decide the time after which we will buy sell, that is called as expiry. We also decide the quantity to be bought and sold after 3 months, that is contract size. And we also decide the most important thing, the price at which I will sell and you will buy, called as forward price. So all set of things decided today only under the contract. We have today only entered into the contract. The execution, the settlement of that contract will happen on its expiry date. This contract, which talks about buying or selling something on a future date, is an example of forward contract. I'm yet to speak in detail what exactly it is, but for now, to give you a sense of what derivative contracts are, derivative contracts are the agreements or the contracts which talk about buying something or selling something on a later date. This is this category. Interest rate derivatives talk about borrowing something or lending something on a later date, on a future date. Yes, sir, before we individually enter into these things, let us try to understand some basics. Spot or cash market versus derivative market. So there is this market where gold or a particular share or a particular bond or a particular any other commodity is being traded. In fact, currency is being traded like dollar yen. So market where all these assets are traded is a spot market, the cash market. And the market where derivative contract on such asset like the future forward options, FRA, IRF, etc. derivative contract are traded is called as derivative market. Sir, the price that prevail in the spot market today is the spot price. For example, today I want to go to the market, I go to the market and buy the share of TCS. What is that? The share price that prevails there in the market, spot market, is called as spot price. There is also a TCS futures which is traded in the stock exchange. That TCS futures is the derivative market and the price would be futures price or forward price depending upon the contract. Fine, this was the most important thing. Sir, why would someone enter into derivative contract? Only three reasons. Either you want to hedge or arbitrage or speculate. Other than these three reasons, there is no reason you would ever enter a derivative contract. Correct? What these things exactly are, we will learn as we enter into each one of them. Sir, moving ahead. Sir, in the spot market or in a derivative market, you take a long position or a short position. Long relates to buying something, short relates to selling something. How exactly are these positions? That when you go to the individual contract, you will learn. Fine. Moving ahead, one more thing for your understanding. Sir, can gold be an underlying asset? Which means, can we enter into a contract to buy or sell gold on a future date? Yes. Can dollar be an underlying asset? Yes. Can a share of TCS be an underlying asset? Yes. Can the stock index like Nifty Sensex be an underlying asset? The answer is yes. Yes. So that is what it is. Just give me a minute. Just give me a minute. Guys, can anyone please tell me if is it buffering or not? Guys, there's no buffering, right? Everything seems to be all right. Correct? Can I continue to proceed? Himanshu, you want to purchase English regular batch. Can you please send me a WhatsApp on this? I'll connect you to the team. They will guide you where you can purchase it from. Yes. So guys, coming back to the first contract, which is future and forward. You know what this contract is. At 0.2 parties enter into a contract to buy the underlying asset on the expiry date of this particular quantity called as contract size at a price decided today, forward price. For us, the terminologies are as important as the entire concept. Sir, please understand, today the two parties have entered into a contract. When you and me enter into a contract, are we actually buying or selling today? No. Today we are only entering into a contract to buy sell. The actual buying selling, the settlement or the execution of the contract will happen on the expiry date. So contract is being entered here, the expiry takes place here, but when the contract is entered there are two parties involved, right? What are the position of two parties? You have entered into a contract to buy, your position is long. I have entered into a contract to sell, my position, people in the class, is short. This is forward contract. Very similar is futures contract with only one or two difference. Forward contract is entered offline market with the dealer. There's some party called as dealer in the market. Futures contract is traded on the stock exchange, because of which this is standardized. Sir, what do you mean? Listen to me. Now, obviously, all that we read has an exam relevance, otherwise we don't discuss it in the class. So something that we don't discuss, please automatically understand has got no exam relevance. Yes, sir, standardized means when two party enter into a contract in the form of forward, you can decide to buy sell any quantity, 10 gram, 15 gram, whatever. However, when this contract happens in the form of futures on the stock exchange, the quantity is fixed. Either it will be 10 gram or multiple of 10 grams, like 20 gram, 30 gram, 40 grams, and so on. Right? So the standardization in futures is needed, and futures require margin. Sir, what is this exact concept of margin? When we come to that particular concept, we will talk about it. Sir, what is the first thing we will learn on the forward futures? So now you know that the concept of forward futures are similar, except that one is a standardized and other is not. The underlying nature of the contract is same, so all the concepts that we now read will be commonly applicable to both of them. Will be commonly applicable to both of them. Just give me a minute. Wait. Uh, yes. Cool. Fine. Sir, what is the first thing you will learn? You will learn that today, when there are two parties, they enter into an agreement today, the share or the underlying asset already has a price today. For example, gold today, when I go to the spot market, the price in the spot market, which is a spot price, is 90,000. Now the question is, at what price should the agreement between the two parties happen? Is it 90, 95, 85? What is the underlying logic or the formula to calculate the price at which agreement should be entered, which both of us find fair, at which the execution will happen here, right? Sir, let us proceed to learn pricing of forward futures using cost of carry model, right? This particular part I will explain later, but let me explain you from here. Sir, one is the price of forward future which actually prevails in the market. That is the actual futures price. What you calculate is always a fair futures price, which is what should be the price of a future, not what is the price. Is the price is there on the market. What should be the price is what we calculate. Yes. So fair forward price, fair futures price, which is also called as theoretical price of today, can be calculated using this concept called as cost of carry model. It says whatever is the spot price of the underlying asset gold in the market today. So today's gold price plus interest you will have to add to the gold price, right? Till expiry. For example, today we see that the gold price is 90. Now the expiry is after 3 months. So on this amount of 90,000, you add interest for a period of 3 months. Then, sir, whatever storage cost has been incurred till expiry, along with adding the interest, till the point of expiry, whatever storage cost is incurred, that also you add, and minus if there is any income till expiry, that you deduct. Such a simple thing. On the spot price you add interest. If there is a storage cost incurred to store that asset, for example gold, I will add that as well. If there is an income generated by that asset till expiry, that is deducted. Fine. Sir, in the class we learned an extended detailed story. Right now the objective is not to narrate the entire story, but to focus on what exactly you want to know from exam point of view. Right. So to the spot, I need to add interest, add storage cost minus income, everything till expiry. Sir, point is, everyone, sir, how would you individually deal with this item? Because for interest, examiner will give you rate of interest the time period till expiry. For income, the examiner give you income in rupee or any other absolute terms, or it may give it to you in percentage terms. This is how it will happen, right? Sir, one more thing. To the spot price, when you do add all these things, deduct income, so the price arrived is called as forward price or futures price of today. Fine. These items or elements which you adjust to the spot price are called as cost of carry or net cost of carry. So if examiner asks you to calculate cost of carry or net cost of carry, how will you do it? Sir, first I calculate the forward price or futures price. From the futures price, if I deduct the spot price, then automatically I know that forward plus is equal to spot plus these things. So from the forward price or futures price, when I deduct spot, I will automatically get the cost of carry or net cost of carry. Yes, taking you ahead to understand how exactly will be the treatment of interest. Yes, I will do that. Himanshu, I will do that. All the live people in the class, are you all able to connect to what is going on? Are you people comfortable with the language, with the speed, with everything which is going on? Come on. I mean, initially, to build that comfort between us, I will take some feedback very quickly. And then, when you are comfortable with the way we learn, then we will be all set. Come on. So, live people sitting in the class here, are you all comfortable? Whatever is going on, are you all set? Come on. Is the language, is the speed, is the way we are learning things, everything set? Lavanya, good morning. Jay, yes. Navya, yes. Praveen, yes. So I would request all the people watching up this lecture, please come to the latest live point because that is where we have a better communication. Yes. And those who have still not liked this video, boss, if you really want to score exemption, then the button to exemption is right there in this form, just below your screen. Well, this is not an emotional pressurization which I want to do. Jokes apart. While, yes, sir, we know that to the spot price we need to add interest. Now let's figure out what are the ways examiner gave you interest. First, the nature of compounding is discrete of the interest rate. The nature of compounding of the interest rate is continuous, or the examiner has not given any nature of compounding. For example, when examiners say rate of interest is 10% per annum, compounded annually, semi-annually, or quarterly or monthly, this is discrete compounding. When examiners say rate of interest is 10% per annum, compounded continuously or daily, this is continuous compounding. Even daily is continuous compounding. And when the examiners say rate of interest is 10% per annum, nothing about the compounding frequency, it is the third category. So I know whether it is this category or this category or this category. To the spot price, I need to add interest. I mean, can I say spot price is my present value? And to add interest into the present value, can I multiply future value factor to it to find out or to calculate the future value? Basic logic of time value of money. Yes, sir. So let's do it. Sir, this is my spot price at 0 point, right? To add interest, I need to multiply future value factor to it. The only difference is that depending upon the compounding frequency, we will change the calculation of future value factor. So if something is discrete compounded, the formula is 1 plus r by k to the power nk. What is the underlying logic? Really simple. Sir, this rate is per annum. K is my compounding frequency. For example, if it is semi-annual compounding, k become 2. So to the R, when you divide by 2, you get the rate per period of 6 months. My annual rate is 10, but the compounding frequency is semi-annual, K is 2. So for a period of 6 months, for one compounding period, I get 5%. To the power n, which means suppose the contract is for a year, so n become 1. It is life in terms of year, right? And k is again the compounding frequency. Your contract is for 1 year, but in a year, how many compounding will take place? So 2 compounding, which is why again multiplying it with k. So you don't have to every time apply this, in underlying logic. The simple formula is 1 plus r by k to the power nk. I know you all know 1 plus r to the power n. I have just modified it to divide it by k here and multiply it k here, so that we can also do semi-annual, quarter, monthly compounding. Yes, people? Fine. Sir, what exactly these things in the formula are? Rate, R is rate of interest. per annum. Please remember the rate of interest is a risk-free rate. However, examiner will anyways give you risk-free rate, and even if it doesn't, you will have to compulsorily use the rate which is given in the question. Fine. So rate of interest per annum. N is time till expiry of the contract in terms of years. If it is 3 months, it is 3 by 12 year. It is 6 months, it is 6 by 12 years. Sir, at last is K, which is compounding frequency. If it is quarterly compound in K is 4, if it is monthly compounding K is 12. So 1 plus R by K to the power Nk is to be applied the formula if it is discrete compounding given in the question. If it is continuous compounding, formula is e raised to RT. R is the rate of interest per annum, T is the time period. There's no underlying logic. Underlying logic lies in the maths. We don't discuss it in the class. E raised to RT give you spot price into e raised to RT give you the fair forward price, fair futures price. T is again time till expiry. Sir, spot price into 1 plus Rn is the future value factor when the question is silent, that give you the fair futures price. So the logic is really simple. The rate of interest, for example, is 12% per annum. For my time period, for example, is 3 months. So you apply simple common sense. That if 12% is the rate for the entire year, then for a period of 3 months, how much is the rate? Into 3 by 12. So you automatically get 3-month rate. Ignoring any kind of compounding, assume simple interest. If 12-month rate is 12%, then 6-month rate is into 6 by 12. So 1 plus rate will you 1 plus rate into time period will automatically give you the future value, ignoring any compounding effect. So to the spot price, when you multiply that future value factor, you get fair futures price, fair forward price. Yes, people in the class. So in the question, in any question where they ask you to calculate the price of forward or price of future, the first thing we're gonna do is to identify the underlying asset and its spot price. The second thing we're gonna do is to identify the interest rate so that we know what is the nature of compounding among the three options. Once you find the interest rate and the nature of compounding, try to find out the time period till expiry. Automatically choose the formula to be applied and automatically you will have the future value. Till this point, everyone in the class 10 out of 10 set. Come on. All the live people waiting for your responses. Are you all 10 out of 10 set? Please tell me. So, very good morning. Who is this ANR1205? Hello? Who's this ANR1205? Yes, boss. So, live people, recorded people, stay tuned. We are going to discuss the things ahead. Now, you all listen to me. So, when I talk about the income, you all know the income to be deducted. See, Storage Cost Institute has never asked a practical question except 1 or 2 times, right? But this income is what we need to focus on. Oh my God, you're Anuka. Great, Anuka. Welcome to the session. Aye, everyone, let us proceed. Sir, income we all know we should deduct. Now there are the two ways in which income may be given to you. One, in absolute form, like 5 rupees, $6 in absolute terms. Another is in percentage terms, which is yield terms. We will try to understand in a manner that you don't have to mug up the formula, rather you all create your own formulas. Yes? So let us all proceed. A gentle reminder to all those students who are watching live to please come to the latest point so that you can connect on a live basis whatever is going on rather than watching it right from the start. Right? Unless you have missed it significantly. For example, it is right now 9:30 a.m. in our watch. Right? So if you think you are close to us, then consider coming to the latest live point. Yes. So just a minute. Are we all ready? Perfect. Set. Come on. Sir, treatment of income. I know income is to be deducted. So now make use of timeline. And in any practical question, if you create or imagine this timeline, the question will never be any confusing or difficult for you. Yes? So come on, let us proceed. Sir, at 0 point, I have a spot price. We know that we have been adding interest to the spot price to calculate fair futures price that you have learned here. Please understand one thing. Even if you add interest, The value on the timeline is here, but that does not mean it is the futures price or forward price of that day. The settlement or the execution happens here, which is why on the timeline it is here, but it is the price of 0 point, it is the forward or futures price of 0 point, because the contract is entered today only. I know the execution takes place here, but this is the price which has to be written down in the contract today only. It is the forward or futures price of today, not the expiry date. That is the first clarity. Second, sir, to the spot price, I need to add interest, but if there is an income, we need to deduct income also. Please apply common sense. To be able to deduct income, I know there is an income to be received after 2 months. Can I deduct it directly from the spot price of 0 point? No. Sir, I need to first discount the income. Now, please try to create the formulas at your own. There is this income which you discount. You calculate the present value of income from the spot price, which is at 0 point. You deduct the present value of income, which is also at 0 point, and whatever is the net number, to the net number you multiply the future value factor, which means that net number is then to the net number, then the interest is added by multiplying the future value factor using any of the applicable formula. That interest, that future value factor, when you multiply, this will give you the fair forward or the fair futures price even when you have income. So automatically, if you have to create a formula, can I say spot price minus present value of interest is the net number, to which you will multiply the future value factor using any of the situations 1, 2 or 3. So you have automatically learned to create 3 formulas at your own, right, in case of absolute income. Now I want to teach you one more thing. Sir, this income, when you discount, for compounding we have to multiply future value factor, but to discount you have to divide it by future value factor. So in the start only you identify which is the applicable scenario 1, 2 or 3, which is the applicable case to the question. The same thing you will apply throughout the question, whether it is discounting or compounding. If it is continuous compounding, for example, for discounting you divide by e raised to rt, for compounding you multiplied by e raised to rt, it continue to remain the same throughout. Yes. Now trying to teach you one more thing. Sir, if income is here, you discount it, compound the net number. Imagine you receive the income on the day of expiry only. Is there a point to discount the income right from the end to 0 point, do the net and compound it back again from 0 to the end? No. What do you rather do? You know that income is anyways there only, and you know that the spot price when compounded will also reach the same point. So rather than discounting income, let the income remain there only. Spot price you multiply with the future value factor so that you calculate the future value of spot. And since the income is there only, then you deduct the income separately to find the net number directly, to find the fair futures price directly. So to the spot price, you multiply future value factor. You take the spot price to the end, deduct the income which is lying there only, and what you get is the fair futures price directly. Could you all understand, people in the class, the particular thing I'm trying to explain? Please tell me. Nikhil, hello, very good morning. How are you? Tell me. Is everything fine? All set? Live people, are you all able to connect what is going on? So let me now take you all to the next. Sir, what if the income is yield per annum? What if the income is dividend yield per annum? Really easy, really simple. Sir, dividend yield. Please understand, dividend may be given to you in 2 forms in the exam. One is dividend rate, another is dividend yield. I have not taken you to the basics in this chapter, but as and when needed, I will explain those basics to you. 1. Dividend rate is the amount of DPS as a percentage of face value. Dividend yield is the amount of DPS as a percentage of MPS, which is nothing but your spot price. Underlying asset spot price is nothing but the market price of share, or is as a percentage of spot price. Fine, sir. If the examiner give you dividend rate, then it will also give you the face value. Multiply the face value with the dividend rate to find out the amount of dividend per share, and through this category, through this situation, you will solve the question. Fine. However, if the amount of dividend yield is given, now please understand the underlying logic. Dividend yield as a percentage of the spot price, the market price of the asset. So please apply common sense that, sir, Interest as a percentage of spot price I add. Dividend, if yield is given, then that also as a percentage of spot price I deduct. If I have to add interest, deduct income of the same base, which is the spot price, why don't I add only the net number? Which means rather than compounding with r, you compound it with r minus y, the net number. E raised to rt, rather than that you use e raised to r minus yt. Rather than 1 plus rn, you use 1 plus r minus y into n. So these three become the modified formula of the original formula. The modified formula are here for you. 1 plus r minus yk to the power nk, e raised to r minus yt, and 1 plus r minus yn, that you apply only when the yield is given. Yes, which means you don't have to separately mug up the formulas. You first identify the interest compounding nature. You get 1, 2 or 3, the clarity. Second, you identify the income type. If it is absolute, this concept gets applied. If it is yield, then this concept gets applied. Such a simple thing. Similarly, the storage cost treatment we don't need to discuss, because we see that institute has rarely given to you any question. But still, on a lighter note, if there is a storage cost, please understand what happens to it. Sir, I know storage cost is added. I have seen it that the storage cost is added. Sir, how would you add it is the story? Sir, similar to the income. First you discount the thing, because you have to bring it to the same point, then you add it. If there is an income, you deduct it. Whatever is the net number, you multiply future value factor to it, so that you get fair futures price or fair forward price directly. Now, one more thing I have to explain. Few more things I have to explain, because I need to make sure that the things are literally 10 on 10 conceptually clear. So, you know that if examiner tell you the compounding nature, you apply respective formula. If the examiner has not given the compounding frequency, it says the rate of interest is 10% per annum, that's all. You might think it is this, agreed. However, if the examiner give you e raised to rt value, assume it to be continuous compounding and proceed to solve it. Logical? Second, sir, one important thing comes into place is two things from the basics. Let me take you to the basics. Right? In our outnotes, you all know that initially we have the segment of basics where we have compiled all the basics together. Sir, whether the rate of interest is discrete or continuous, sometimes we are not able to identify. So let's proceed to look into it. Just give me a second. Just give me a second. Yes, boss. Shall we all proceed? So, examiner may give you the rate of interest as 2%, or it might tell you 200 basis point. So you have to please realize 1% is equal to 100 basis point. So it's like rupiah versus paisa, percentage versus basis point. The same thing in the decimal is 0.02. Second, if the examiner say rate of interest is 10% per annum, 10%, rate of interest is 10%, you have to please realize in the entire AFM, whenever a rate is given, unless otherwise specifically mentioned, you have to consider it per annum. Unless it says it is per month or per 6 month, unless that is given, in all other scenario, it is per annum. But sir, 10% per annum, what is the compounding frequency missing? We don't know. Sir, examiner may say rate is 10% per annum compounded annually, which means one shot compounding in a year. If it is 10% per annum compounded semi-annually, which means rate is 10% only, but the interest will be paid, or the interest gets compounded every 6 months. Fine. The rate is continuously compounded, which is fine. The main thing I want to explain is this two scenario. When examiners say rate is 5% per 6 months, it is very clearly specifying it is not per annum, it is per 6 months, which means for a period of 6 months, the rate is 5. Then on the next 6 months, it is again further 5%. But please realize Rate is 5% for 6 months means for the next 6 months, if you want to again use this rate, there will be a compounding, there will be interest on interest. So can I say this is nothing but 10% per annum? The rate, if you realize 5 plus 5, total of 10% per annum, just that the compounding of that 10% is semi-annual. So 5% per 6 month is equal to 10% per annum compounded semi-annually, falling under the category of discrete. Similarly, when examiners say 1% rate is 10%, 1 month rate is 10%, does it mean for every 1 month the rate is 10%? No, it means 10% per annum. Then what is the relevance of this 1 month? It means when you want to borrow for a month, the rate is 10% per annum. How, what if you want to borrow for 2 months? You can, but again at the end of every month there will be compounding, meaning so this is nothing but 10% per annum compounded monthly. These two specific scenarios where it is hard to identify what rate is given to me, sir, I wanted to explain. Are you all clear? Which means in conclusion, this is discrete, and this are obviously discrete. This people in the class is, I mean, when they say continuous, it is continuous, and this scenario is when the question is silent. This is the first thing I wanted to explain regarding the interest rate. Second very interesting thing is about the day counting rules. Right. Sir, when examiner give you derivatives, information of a future, forward, anything, listen to me carefully. If they don't specify date, if they specify month, life is sorted, take 3 by 12, 4 by 12, whatever is the month duration given. If the examiner specify the dates, like you took a future position on 1st April, closed it on 31st of May, when the dates are specifically given in the entire AFM, I'm talking about the day counting rules, you will have to make day-wise calculation. Sir, what are the exact rules of day-wise calculation? For example, my holding period is buying date is 15th November, selling date is 15th Jan. What do? Don't count 15th. 15th is ignored. Right from 16th November to 31st Jan, you count. So 16th November to 30th November, 15 days of Jan, 31 days of 15 days of November, 31 days of December, 15 days of Jan, give you total 61 days. Logical. 31st October to 15th Jan. You don't count 31st, you count from 1st November to 15th Jan. 30 day of November, 31 of December, 15 of Jan, give me 76 days. This is the important point, which is of the logic, which is based on my observation in the institute's practical question. 1st November to 15th Jan. Ideally, 1st November should be ignored, ideally, logically. First day we ignore. But whenever your first starting date is a start of the month, like 1st November, 1st December, we have observed that institute also considers or also count the opening date in its calculation, which means right from 1st November to 30th November, again 30 days of November, 31 of December and 15 of Jan, same 76 days is my holding period. So 76 divided by 365 is what I will have to do whenever it comes to the period adjustment. Boss, this is the main thing I wanted to teach you. Now sir, in the entire AFM, it is all 365 days except for the 3 places. When we go to FRA, when we go to the swap in the today's lecture, I will tell you, again there is this something called as money market yield. In the money market instrument, there's something called as discount yield, where also you take 360, which is a different story. Right now we need to focus on this part. Could I please explain to you all the day counting rules? Everyone in the class, please tell me. Was I clear with the interest rate frequency and the day counting rules that we have learnt in the basics? If you say yes, I'll immediately take you to the practical questions. Come on. I'll immediately take you to the practical questions. Shall we all? So sir, we are all set till this point. Now one more thing. Last thing of practical understanding before I take you to the practical question, because I want to compile all the concepts first and then only take you to the practical questions. Listen to me guys, very important, very easy. Sir, when the examiner has given to me the dates, fine sir, for example 1st April to 31st of May, You did the calculation, for example, April is 30 days, May is 31 days. So you say 61 divided by 365. Suppose you are doing e raised to rt. So e to the power r, for example, rate is 10% into 61 divided by 365 is the time period. The value is 0.1 into 61 divided by 365 is 0.1671 something, 0.16 or 0.0167, whatever is the answer. But you see that the value of e raised to rt, which is already given in the question, e raised to the power x, is not given the value given in the question is not matching with it. Then what? When you see that the value is not matching, which means even if it is illogical, you will have to make the adjustment. Like rather than 61 and 365, you try 2 by 12. That if I do month-wise calculation, even if the dates are given, but doing month-wise calculation, if it matches the e raised to rt value, then it is a clear hint that you should do month-wise calculation. So whenever examiner has the value of e raised to rt given to you, it is a blessing that you cannot do that particular question incorrectly. Logical? And whatever I've specified, I just talked about is mentioned here. You first do n divided by 365. If it doesn't match, then do n divided by 12. The answer will then match at least. Fine. So you guys are, from my side, literally 10 on 10 set to all these concepts. I'll now immediately take you to the practical questions. Just give me a minute. Just give me a minute. So one point of your understanding and knowledge is that this file, the outscanner that you're referring to, the same file I will convert into the LDR's last day revision question. This last day revision question is for the attempt of Jan 26 and onwards. Whenever you people are watching this video, you might find the last day revision questions for your attempt on Telegram, right? Or you can ask me on the Telegram group. There is also one doubt solving group of Telegram about which the link I will share in the description. You can join that group so that you can ask your doubts and respond to others' doubt if you want. Sir, now for example, you're watching this lecture after a year. And by that time, suppose the book is updated. So the book that you have has, for example, one more question. That is when the sequence will change somehow here and there. But you can broadly understand, for example, if you want to do this question. In your book, it might be question number 3 or 4 or 1 or 2 question here or there. But more or less, it will be around question number 2 only. Yes. So for now, let us proceed. Everyone, taking you all to the practical question, and please think that you will have to at your own solve it. I'm not going to solve it. Before I solve it, you will have to solve it. Yes? So let's go ahead. Everyone, 31st August 2011, 31st August 2011, the value of stock index, what it says, on 31st 2011, the value of stock index is 2200. Please try to understand what information is given. The value of index is given. Is the index futures or the underlying asset itself? Sir, index is the underlying asset, like Nifty Sensex is the underlying asset, similar to the gold share or any other asset. Fine. Whose price is 2200. So the price of the asset is the spot price. The risk-free rate of interest is 8%. Sir, our rate of interest per annum is given. My question to you all is category 1 or 2 or 3. Sir, examiner has not talked about the compounding frequency, whether it is discrete or continuous, which means the question is silent, third category. Sir, the dividend yield on the index is given. Dividend yield, people in the class, has been given right from January to December on an annualized basis. The yield of per annum has been this. Assuming that interest is continuously compounded, boss, it is continuously compounded, which means e raised to rt is what I will have to now use. Find out the futures price of a contracted deliverable on 31st December 11. Let us develop an habit of the most important habit that I've talked about in every batch, whether English batch, Hindi batch, exam oriented batch, regular batch, power batch, any batch. Sir, once you understand the concept really well, you should be able to apply the concept to the question, and also you should be able to fit the question to the concept. Let's try to fit this question. Do you see the question is asking you to calculate the futures price? Which means it relates to the cost of carry model. In the cost of carry model, we need the spot price. To the spot price, we need to add interest, for which I have to identify category 1, 2 or 3. Sir, since it is continuous compounded, it is category 2, which means I have to do e raised to RT. R, the rate of interest per annum is given. What is my time period? Today is 31st of August and the examiner says the contract is deliverable on 31st December 11. So T, time period also given, it should be days divided by 365 logically because date is given to me. Fine. Sir, what is next? Sir, after that we also have been given the income. Sir, income if you observe is given in yield terms. So rather than R, I will have to do R minus Y. So R is already there with me, the yield. Do I have the yield? Yes, sir. Yields have been there. Are these all the yields relevant for me? No. I said income till expiry from 31st August till 31st December, which means September, October, November, December is the yield. All these yields are already per annum. If I need one particular number, I'll have to average it out. So 3 plus 3 plus 3 plus 4 divided by 4 give me 3.25% is the yield per annum. So if I have the rate per annum, yield per annum, time period, spot price, I have everything. I just have to now apply the formula. Before I proceed to solve it in numbers, could you all please understand the entire thing at your own? Please tell me. Could you all imagine the solution or the formula for this particular question? Everyone in the class, please tell me. Are you all there with me live? Come on. Everyone in the class. So fine, sir. Let's proceed ahead. So spot price is 2200 into e raised to R is 8%, Y is 3.25%, T is 4 by 12. Why, sir? Why is it not September, October, November, December, everything added divided by 365? Because the value of e raised to RT will not match when you try it. The value of e raised to RT will not match when you try it using days. So e raised to RT give you a hint that if the days are not working, try to apply months. When you apply month of 4 by 12, the value matches. For example, 0.08 minus 0.0325 multiplied by 4 divided by 12 give me 0.01583, the value of which is given to me. So spot price of 2200 into this value is the final answer. Please observe. Question thinking, understanding takes time. In derivative forex, understanding, thinking, the question takes time, solving doesn't. Because the more effort is spent on choosing the right formula, choosing the right number, once you choose the right number, the solution is 3-4 liner solution if you observe. Question second gets done, where you learn to apply the cost of carry model for continuous compounding. Sir, third, see, listen to me, what is the plan? I will only talk about the questions that we're gonna do in the class, right? I will also share an LDR file for the attempt of Jan 26 and then hopefully for every attempt, from where you will be able to identify which questions are category A question and category B questions and which one are the category C question which you can ignore. I mean, first solve B and A and B, then only if you have time go for C, otherwise don't go for it. Fine. Second gets done. Next question we're gonna do is question number 5th, but before that you need to learn the next thing. So far you have learned that at 0 point when you stand, how do you enter a forward contract? Now we will learn, once a forward contract is entered, how is it settled on expiry? Fine. In the entire curriculum, you will see two types of settlement, delivery settlement and cash settlement. Understand this chart really great because this chart becomes the basis of all your learnings in the coming topics. Fine. Sir, delivery settlement is really simple. It means do what you agreed upon. For example, at 0 point, if we talk about when we entered into the contract, you said you will buy, I said I will sell after 3 months. So that is what you have to do. At the end of 3rd month, when you and me reach, when you and me stand, you buy gold from me. I sell gold to you. You pay me agreed amount of 92,000. I receive from you the agreed amount of 92,000. Overall, I give you gold, you give me 92, and that's how the contract is settled. How simple. Delivery settlement is agreeing, doing what we agreed upon. What you have to know in this thing is about the inflow outflow. When I entered into a contract to sell you something, then on the day of expiry, I will sell you. So when I sell you, I will get the inflow of the agreed forward price. If I enter into a contract to buy something, then on the day of expiry, I will buy. And when I buy, from my pocket it will be an outflow of that agreed forward price. So for finance, by settling means you should be able to imagine what are your inflows and outflows happening. Then is net settlement, cash settlement, another very important thing. Listen to me. Before I explain to you net settlement, which actually is nothing but calculating the gain loss on futures, let's understand something, the spot price and the futures price. Boss, suppose the share price of TCS is 4,000. What should the future price of TCS? Sir, spot price plus the interest, storage cost minus income, which means plus the cost of carry. Suppose the future price is 4400. This is the futures which expire in December. We stand on 1st Jan. December is the expiry of the future, which means interest and everything has been added for 1 year. Time till expiry is 1 year. Share price over the period will change in the spot market. Yes, sir. Suppose on 30th of June, which is after 6 months, the share price become this. If I ask you what is the futures price today of this future which expire in December, so please remember, again you will apply cost of carry model. Learning number 1, the futures price of TCS future on that day will depend upon the spot price of that day. This day's futures price was dependent on the spot price of that day of 4,000, but this day's of futures price, future price of this day will depend on the spot price of that day of 4500 is my point. So on the spot price of 4500 you will add interest and everything, but now the time till expiry is just 6 months, so you will add the interest and storage cost and deduct the income only for 6 months. Similarly, when you go to expiry, the spot price gradually changes. The futures price is spot plus cost of carry, which means you add the interest and storage cost, deduct income just for 0 day, which means you don't add anything at all, meaning to say the futures price of that day will be equal to the spot price of that day, meaning to say when a contract expires, the futures price of on the day of expiry is equal to its spot price. Two important learning. First, the concept of convergence, that the spot price or the future and the futures price gradually converge as we reach to expiry. In other words, on the day of expiry, the futures price is equal to the spot price. Learning number 1. Learning number 2, at any point if we have to calculate the futures price, it will be based on the spot price of that day. It was learning number 2. Now learning number 3, you will learn to do the cash settlement or the net settlement. People in the class, please look at this. Come on. Sir, at 0 point, suppose the TCS share price is 4,000 and this is the most comprehensive chart. We have talked about the settlement on the day of expiry, also the settlement before expiry. We have talked about what if the market is bullish and what if it is bearish. We have also talked about what if the position is long and what if the position is short. The most comprehensive chart you would ever see on the learning of net settlement of future forward. Right? So come on, people. First point of learning, if someone asks you to calculate the gain loss on futures, the price that matters to you is the futures price, not the spot price. Which means if I have given the spot price and the futures price, the row which tells you the spot price is not relevant for you. What is relevant is the futures price. Sir, when it comes to net settlement or cash settlement, think simply that you are buying and selling an asset. Don't think that you are buying a future of that asset. Think as if you are actually buying and selling the asset. For example, this calculator I purchased for 150 rupee, sell it after 6 months for 180. How much is my profit? 30. Similarly, suppose I sell this calculator first, I sell it for 100 and later I buy it back for 120. Selling is 100, buying is 120. It is a loss to me of 20 rupee. Meaning to say, sir, think as if it is an asset, right? So, but for that you will have to use futures price. The formula or the logic or the understanding of gain loss is always simple: inflow minus outflow. When you sell an asset, you get inflow. When you buy an asset, you have to pay outflow. And inflow minus outflow is always the gain loss, irrespective of first you buy something or first you sell something. First you buy something, it is called as long position, and if you sell something first, it is short position, irrespective of whatever you do first. Whatever you do first. Inflow minus outflow is the equation of gain loss. For example, everyone in the class, it's very interesting, listen to me. Today the price is 4400. In the futures market tomorrow, suppose the price become 4700. Can you tell me gain loss? Never. You can never tell me the gain loss if I give you the price, but if I don't tell you the position. Position decides gain loss. Sir, at 4400 if I do long, which means if I do buy, 4400 when I buy is the outflow. After 6 months, to calculate profit, I will have to square up my position, close my position, which means I will sell it. When I sell it, there will be an inflow. So inflow minus outflow is the gain loss, which means gain of rupee 300 is the simple thing. Sir, what if the price turns out to be 3780? So 4400 buy, outflow. 3780 I will sell will be my inflow. And inflow minus outflow, when I do, it is a loss of 620 rupees. Logical, easy. What if the position is short? 4400 I sell something, which means I have an inflow. Later on, after 6 months, price become 4700, at which I will have to buy to close my position because initially I sold. Then it will be my outflow. And inflow minus outflow when I do is a loss of 300 rupee. Similarly, here it is a gain of 620. Why? 4400 inflow minus 3780 outflow. Difference is your gain. The simple equation, the simple table help you understand the gain loss very clearly. Suppose on the day of expiry, if I have to settle, I went to the market and I saw that the futures prices were not available to me. Without knowing the futures price, can you ever calculate the gain loss? Closing futures price, if you don't have, will you be able to calculate the gain loss? Yes. If I have the spot price, because using the logic of convergence, on the day of expiry, spot price is equal to futures price, which is why I can assume the same to be the futures price and then solve the equation. Solve the question for gain loss. Logic is futures price is not being compared with the spot. It is that the spot is turning out to be the same as futures, which is why to us it feels that we are comparing it with spot. But otherwise, please observe, if it is before expiry, it is never ever spot. It is always futures with futures price. Yes. At a price of 4400, if you take a long position, which means buy outflow, and later the price become 4300, now to square off you will sell as inflow, and inflow minus outflow is 100 rupee of loss if you observe. But if it is short position, at a price of 4400 you sell it, there is an inflow, you buy at 4300 outflow, there is a gain of rupee 100. That's how you calculate the futures price gain, futures gain loss on expiry, before expiry, in bullish or bearish case, in any position that you've seen. The settlement, the most important thing I believe in any future forward contract, you must learn. Because when you take a position, you settle it. In any concept in AFM that you learn now, in derivatives, there will be some settlement. And if you don't learn settlement really well, then all those questions become somewhere incorrect. Boss, how much out of 10 are you people settled on the settlement of futures topic? Come on, tell me. Please, everyone in the class super fast. Come on. Based on which is a practical question, which is question number 5 we're gonna discuss now. Now we are 10. Lavanya, 10. Come on, others in the class, please. What is the status? If you really found the chart to be helpful, knew something that gives you better clarity, then I am happy about it. Yes, great. Sir, question number fifth. Let us proceed. Just give me a minute. Let me have water for that. Yes, boss. Yes, boss. Yes, boss. Let's start to read question number five. By the way, out of curiosity, how much are you expecting the lecture to be? It will be for around 6 to 7 hours. 5 to 7 hours, not 6 to 7. Somewhere between 5 to 7 hours. All right. I mean, if you all want me to explain the concept really well and also solve the practical questions on that, it does take at least this much. Fine. A future contract is available on R Limited that pays annual dividend of rupee 4 whose stock is currently priced at 125. Wow. When you start to read the question of derivatives, people, please make sure that you are able to identify those specific things in the question. Future contract is there on R Limited, which means R Limited is the underlying asset. R Limited share pays an annual dividend of 4 rupee. Details of income whose stock is currently priced at 125, meaning to say the spot price is 125. Fine, sir. Each future contract call for delivery of 1000 share. As I said, the contract for futures is standardized in quantity. So every contract talks about buying, selling at least 1000 share and then in the multiple of thousands. Sir, in 1 year, when should the buying, selling, or when should the delivery happen? In 1 year, which means time till expiry is 1 year. Daily mark to marketing, please ignore it right now. Corporate treasury bill rate means the risk free rate. Ideally, it is not risk free, but we are bound to assume it to be the rate 8%. Sir, given above information, what is the price of one future contract? As you hear the word price of one future contract, the topic that should come to your mind is cost of carry model, in which you have to first identify the spot price. Yes, sir, spot price of today 125 there with me. S0 there with me. Next, I identify the interest rate. Yes, sir, 8%. Then I identify the compounding frequency 1, 2, or 3. Sir, third, examiner is silent about the compounding frequency. Simple interest based calculation. Fine. The next is I identify the income. Income is 4 rupee, but the examiner is silent when is it received. So the best possible assumption is that it is received on expiry, which means received after a year. So what is the situation? The situation is that I have a spot price here 125. There is an income of 4 rupee here. What do you do? Sir, you first you take your spot price to the expiry and then deduct 4 rupee of income, and the net number is already directly the fair futures price. To do the future value, you have to multiply future value factor, which is 1 plus Rn. If you imagine the timeline, are you able to fit the question to the concept is my point. The main learning of first learning the question, first learning the main point of first learning the concept and then doing the question is that you should be able to fit the question to the concept. Are you all able to fit it here? Yes, boss. So now let us proceed. 125 is the spot price multiplied by 1 plus Rn. Rate is 8%, time period is 12 by 12. So 1 plus 0.08 into 12 by 12 minus the income 4 multiplied by the contract size. So that under every contract, if there are 1000 share, overall I can find out the value of the entire contract. Agreed? You have to also write down the formula in the exam and then only the final equation. When you solve it, what do you get? 0.08 into 12 by 12 plus 1 into 125 into 1000 is minus 4. Minus 4 into 1000 is 1,31,000. Fine. If the stock price decreased by 6%, then what is the futures price? So rather than share price being 125, if it become 117.5, Then what is the futures price? Again, same logic, the share futures price become 122,900. No change, same logic. Just that this time you take the revised spot price of 117. Everything else continue to remain same. Fine. Third and most important part for which we are doing this question. As a result of ABC stock price decrease, will an investor that has a long position in one future contract of R Limited realize gain or loss? What a question. Someone who has taken a position in one contract, quantity is one contract which has 1,000 futures. Fine. He has long position, he has purchased. So out here, when the futures price was 131, you purchased it. Now, as a result of stock price decrease, has the futures price also decreased? Yes. So when you purchase something of outflow, after later on, when you want to settle the position, you will sell it. There'll be an inflow. An inflow minus outflow is the gain loss. 122,900 minus 131 is 8100 of loss. That is question number 5th gets done. Learning to calculate the gain loss. Boss, are you all ready? Understanding it, understanding what is going on. 5th question gets done. Then the next question, before we solve it, we will have to do a next practical topic. So you can assume that we do a topic, solve a question of that topic, do a topic, solve a question of that topic, and that's how it goes on. People, please tell me, are we all ready? Are we all set to go to the next topic, futures and forward? Again, I would seek your validation. The way it is going on right now, learning the concept, applying to the question, is that entire thing going on as per your, yeah, are you finding that comfortable? Please, everyone. Are you all, please, everyone in the class, comfortable with it? Yes. Listening to me? I hope none of you, as I speak so fast, I hope none of you enter into the sleep and go to the moon. Yes, because when it is otherwise a live batch, I ask for so much of response that you are bound to be awake because you have to speak up. Right now, the lecture has been less communicative because obviously I have to speak more to save time. Next question can be solved only when you learn the next concept, arbitrage. So please understand what is happening in the outnotes. First, you have learned that what is the price at which contract is entered. Then you learn how do you settle that thing. And once you have learned to enter and settle a thing, please figure out why do you enter a contract ever. It is either hedging or arbitrage or speculation. So you are now going to learn arbitrage. Everyone, what is the concept of arbitrage? Really easy. Sir, when you do buy something at a lower price and sell it at a higher price, when you get this advantage of mispricing, when the same asset has two different prices in the two different market, then it is called as mispricing. To get the advantage of mispricing, buy something at a lower price, sell it at a higher price, and this buying and selling transaction, the opposite transaction that you do in the opposite market is arbitrage. And through arbitrage, through that mispricing opportunity, you are always able to make a gain which is risk-free in nature. Yes, whatever I explained about the arbitrage has been written down here. Now I take you to the practical question of arbitrage. So, take you to the concept of arbitrage. Sir, for example, I have been given the spot price and other details. Can I calculate the fair futures price using cost of carry model? Yes, sir. We just learned it, right? Identifying the interest category 1, 2, 3, income absolute versus yield. You find the fair futures price. You know that one is fair, which we calculate, and we know that there is one more thing called as actual futures price, right? Which is the price that prevails in the market. Can the two prices be different? Obviously. So when the actual futures price, the price already there on the market, is not equal to the price that we calculate using cost of carry model, which is fair futures price, then there is mispricing. If there is a mispricing, then there has to be a profit, risk-free profit that should be able to earn, provided we do the process of arbitrage correctly. What is the process? Sir, first we identify, after calculating fair futures price, we identify whether the actual futures which are there in the market are overvalued or undervalued. You have to comment on the actual futures price. If the actual futures price is more than fair futures price in the market is more than what you calculate, then futures are overvalued. And if the actual is less, we say the futures are undervalued. If it is overvalued, the type of arbitrage you do is called as cash and carry arbitrage. If it is undervalued, the type of arbitrage you do is reverse cash and carry arbitrage. The names are just you is something that you just have to remember, maybe for an MCQ point of view question, but the process has nothing to do with the name. I mean, it has to do with the name, but we won't learn it. Fine. Futures when are overvalued, let's apply to imagine, let's start to apply the common sense and create the method or the process of arbitrage at our own. Please tell me, when something is overvalued, what do you do? Between buying and selling, what will you choose to do when something is overvalued? Sir, I will sell it. So if the futures, actual futures in the market are overvalued, I will sell the futures in the futures market. In one market when you sell, then in the other market you will buy, which means you will buy that in the spot market. Sir, today when you go to the futures market to sell it, it is only the contract you enter into, there is no inflow outflow happening today. Yes sir. However, when you go to the spot market to buy something, it is a spot market where assets are being bought and sold. When you buy something, you have to also pay money for it. So to be able to pay the money, you borrow the same amount of money equal to the spot price so that you borrow and you are able to pay it. When something is overvalued, you sell it. You sell it in the one market, then obviously you have to buy it in another market. To be able to buy it in another market, you will have to first borrow it. That simple is the process. Sir, when something is undervalued, you buy that thing. So when you buy it in the futures market, you will have to sell it in the spot market. When you sell something, you receive the amount. What do? You invest that amount. That is the process that you have to start today. Please listen. It is the start of the process that you do today. How does the presentation of it happens? Sir, we say there are three markets: spot market, futures market, borrowing market, investment market, right? Today we do something which means enter into that position, on expiry we close all those positions. And this table is simply a presentation of inflows and outflows. Like today, for example, today when we take the position, when we start the arbitrage, sir, in the futures market, for example, we sell. When you sell something, there is no inflow outflow. Listen to me. When you sell futures or buy futures, it is just the contract being entered into, there is no inflow outflow. But in the spot market, when you buy, there is an outflow. In the borrowing market, when you borrow, there is an inflow. So net net, it becomes zero. On a lighter note, you need to understand it. As I go to the practical question, you'll be able to better understand it. Sir, today it is just the position. I mean, this yellow box tells you the position that you have to take today. On the day of expiry, step number 3 is there: square off or settle the positions on expiry and earn the arbitrage profit. Sir, on the day of expiry, the timeline, keep it ready in your brain. You start your arbitrage today, take this position. On the day of expiry, you settle the positions and automatically the difference is arbitrage profit. Sir, how do you settle it? That I will tell you as we go to the practical question, right? For example, futures, when you sold it, you settle it. Either delivery settlement or cash settlement, you have learned it. You have learned both the settlement. In the spot market, you bought something, you settle that also. In the borrowing market, you borrowed, you repay that. And the difference will always be your arbitrage profit. I mean, this table is simply the inflow outflow table. When you do any transaction, just imagine, will it be inflow or outflow, or will it be nothing? If it is inflow outflow, write it in the table. That simple is the arbitrage process. Let me take you all to a practical question and you'll be able to connect. Question number 9 is the first question that we do of this type. Come on. This question will make you practice further the concept of cost of carry. Come on, come on, come on, come on. So let's all people get ready and solve it. Yes, come on. The share of X Limited is currently selling at rupee 300. There is this particular share which is selling, which means this is the spot price. Risk-free rate 0.8% per month. 0.8 per month, which means if it is every year, then it will be 0.8 into 12. 0.8 multiplied by 12 is 9.6% per annum. But the compounding remains monthly, which means it is a discrete thing. You have to please understand it. A 3-month future contract is selling for rupee 312. Sir, in the market, the actual future price of a futures contract whose time period is 3 months is selling at 312. So please understand, there is this future contract whose underlying asset is X Limited, whose spot price is 300, whose actual future price is 312. Time till expiry is 3 by 12 years, and the rate is 9.6% per annum compounded monthly. Can you identify how is the information given to us? Develop arbitrage strategy and the riskless profit that will be, and show what will be the profit 3 month, hence arbitrage strategy. To be able to do the arbitrage, let's find out if there is a mispricing or not. I have the actual futures price. Do you people think fair futures price can be calculated through it? Come on. Do you people think fair futures price can be calculated? Come on. Sir, if I have the spot price, the first I do is to identify the rate. It is there. Then I identify category 1, 2 or 3. Sir, it is category 1 discrete. Then is there an income? Sir, there is no income fortunately. There is no income fortunately. So automatically 1 plus R by K to the power NK multiplied by the spot price is the formula. Right? Rate of interest is 9.6% per annum, where compounding frequency is 12, N is 3 by 12, K is again 12. When you solve it and multiply with the spot price of 300, what is the fair futures price you get? 0.096 divided by 12 plus 1 into equal into the spot price of 300 is 307.25 or 26 on a rounded off basis as the fair futures price. Comment on the fair price and tell me if the futures are undervalued and overvalued. You will say 307 is undervalued. If you literally say it, you are incorrect. Why? Because we have to comment on the actual, we have to comment on 312 and say that 312 is overvalued if you all realize. Correct. If 312 is overvalued, what is the arbitrage you do? Cash and carry arbitrage, which means something that is overvalued you sell. So I sell future. So opposite nature of transaction, the spot market today. Today I sell future at 312. Today I buy spot asset for 300 and the same amount I borrow. So let's look how does the arbitrage table look like. In the future market, I sell a future at actual futures price of 312. Cash inflow outflow 0. In the spot market, I buy the share for rupee 300. There's an outflow. The same amount I borrow in the borrowing market for 300 rupee, and the net is 0 today. Fine. Let's talk about the settlement. Which settlement will you do? Sir, let's do delivery settlement. Delivery settlement was doing what you have agreed. At 0 point, I agreed that I will sell you a share at 312. I will sell you the underlying asset at a price of 312. On the day of expiry, I will give that share to you. You give me that 312 rupee, and 312 is my inflow on the day of expiry when I settle futures. Logical? Logical. Sir, what about the settlement of spot? When you bought a share, do you agree the share has been settled? The share has been sold to the other party when we went to settle the future. The share got delivered to the other party when we went to settle the future. So the spot market position and the future market position simultaneously got settled when I delivered the share under the futures contract. Fine. Sir, the borrowing. When something you borrow, you have to repay, and use the same interest logic, which is, sir, when you borrow 300 rupee, at a rate of 1.0.096 divided by 12 to the power nk 3 by 12 into 12, the repayment amount, everyone, is 307.26. The repayment amount is 307 by 26 is the outflow. When I sell something is the inflow, borrowing gets repaid, it's an outflow. Please observe all three positions which were taken today on the day of expiry after 3 months, all of them get settled. And if you do the final gain loss calculation At 0 point, there is nothing which went off my pocket. But on the day of expiry, automatically 4.74 came to my pocket, and that's why it is my arbitrage profit. Yes. If the futures price is 312, then I did cash and carry arbitrage. I started with this transaction, I settled those transactions, and ultimately this is my profit. What kind of settlement did you do? Delivery. Requesting people in the class your responses. How much out of 10 are you people please clear with the discussion which I've just made with you people in the class right now? Super fast. Come on. How much everyone in the class are you people please set? Because I want to explain to you one more thing, really important thing. Sir, anyone in the class may ask, why did you not do net settlement, sir? I'll explain that. I'll explain that. But first, before I do it, I need your response. Recorded people, please give me your genuine responses by way of the comment right now, or maybe whenever you like you watch the entire lecture, you will realize, and I want you all to literally give me your feedbacks about how was your overall learning with this. Yes, just give me a sec, let me have what. बोलो भाई, चलो भाई आ जाओ. Oh my god, I spoke something in Hindi, the last 2 3 words. Chalo bhai aa jao. I think some of you would be able to connect to what I said. It was like, come on, brother. So, there are two choices to settle, either by delivery or either the cash settlement. Yes? When you do cash settlement, you need the prices of 2 points. Today, when you take a position, you need the price of that point, the futures price. And again, when you settle the position on the expiry or before expiry, the futures price of that point you need. Unless I have been given the prices of both the points, I cannot calculate gain loss and I cannot do the net settlement. But I can do the delivery settlement, because for delivery settlement, I only need the original price at which the contract was entered. For example, in this practical question, I entered into a contract for 312. Today, at whatever price the contract is entered, at the same price, the buying, selling, or the execution happened. On the day of expiry, I need a price if I want to do a net settlement, which is not given in the question. Question 9th gets done. The next question is question 10th, where we will learn to do the net settlement because we have been given the prices on the day of expiry. Let us super fast learn question number 10th. Solve it. NSE 50 index futures. Wow, what a line. A futures contract whose underlying asset is NSE 50, which means National Stock Exchange Index. Nifty 50 index is the underlying asset, is traded being rupee value at 100 per point, which means multiplier is 100. On 15th September, the index closed as 1195. The index itself, which means the spot market price is 1195 on 15th of September. December futures on 15th September, December futures were trading at 1225, whose trading day is 15th of December. So on the same date of 15th September, there were futures in the market which were trading at a price of 1225, actual futures price. The historical dividend yield has been 3%, borrowing rate has been 9% per annum. Examiner has given the rate with no compounding frequency. It has given to me the dividend yield. So first, third category, 1 plus Rn formula, and yield is given 1 plus R minus Yn formula. Yes, I hope everyone in the class, the possibility of formulas that you have learnt in the cost of carry model, you are able to apply those things here. Fine. Determine the September 15 December futures are underpriced or overpriced. I have to find out the price. I have to apply cost of carry model. Do I have the spot price? Yes, sir, 1195 with 00. with the rupee effect. Fine. Into 1 plus, rate is 95, y is 3. So 1 plus 0.095 minus 0.03, using 365 days I have to do the calculation. Because I have been given the dates 15th December and 15th September. So from 15th September to 30th of September, I mean ignore 15th, 15 day of September, 31 days October, 30 days of November and 15 days of December is 91 divided by 365. When you solve this equation, you get the fair futures price as 121,436, where the actual futures price is 122,500. What do you say? Sir, actual is more than fair. The futures are overpriced. What transaction will you do? When something is overpriced, we do cash carry arbitrage. Sell future, buy spot and borrow. And then we settle those positions on 15th of December to complete the arbitrage. Next is calculate gain loss. If the index on 15th December closes at this point, sir, please observe what happened. On 15th of December, which is my expiry date, on that day, the spot price, the index value is 1260. We have not been given the futures price of expiry date, but we have been given the spot price. I need futures price to be able to calculate the gain loss for net settlement. Sir, can I apply the concept of convergence and say this will also be the futures price on the day of expiry due to convergence, and if I have the futures price, examiner is giving to me the hint to do the net settlement. Yes, boss. Are you all able to please connect to it? So let's do the net settlement, everyone in the class. What it says? It says that 0 point you sell the futures. Listen to me. It has one more thing to teach you. At 0 point you sell the futures. Right? What is the point at which, what is the value at which you sell it? Sir, the actual futures price is 122,500, but there is no inflow because it is just the contract entered. Then in the spot market, I will buy it. What is the spot price? 119500. Fine, sir. The same amount I borrow, net is 0. Whatever you did on 15th December, let's settle it. Start with the settlement, and everyone, let me tell you, this is people in the class net settlement here. Sir, why is it net settlement? Because I have the closing futures price. If I sell something at 122,500 and buy it back at 126,000, when you buy something is an outflow, when you sell something is an inflow. An inflow minus outflow is gain loss. 122,500 inflow minus 126 is outflow. There is a loss of 3500 that I will incur on futures. Sir, in the spot market, I bought at 119500. Now I sell it. If the future is settled by delivery, then the spot market position also goes off. Because if I have to settle by delivery, which means I have to actually sell the underlying asset to you under the contract. However, when we only settle net, which means please observe what is happening. I missed to spoke one particular line which I'm speaking now. When you say delivery settlement, you are actually buying and selling the underlying asset. But when you say net settlement, we only do adjust in cash the gain loss. I pay you the amount of gain, you pay me the amount of gain, and only the net settlement in cash happens. There is nothing which happens to the underlying asset, which is why, sir, when I buy the underlying asset, and the future is net settled, the asset continue to remain with me. Now I will have to sell it in the spot market. Where are the assets being sold? The asset market, the spot market at a spot price. The spot price is 126. That is the price I receive when I sell the underlying asset. When you borrow something, 119500 at the rate of 9.5 for 91 days, the repayment is how much? Amount of borrowing rate into time period is 122,330. The amount of repayment. Ignore this column for right now. Amount of repayment. One point of learning. Whenever income is there, whenever the income is also there, people in the class, in the table of arbitrage, you will have to also show income. So let's show the dividend to be received. Sir, dividend yield has been given, which means it will be received as a percentage of spot price. 1195 is the spot price. 1195 of which 3% is the yield, but per annum, my period of holding is 91 days. So how much income will I receive over a period of 91 days? If 3% is the rate per annum, it is 893 rupee of income you will receive. If I do the net of all this, I get the arbitrage profit to be 1063.44. I'm not doing the calculation, I'm showing you the calculation. Yes, sir, what has happened? If you do net settlement, then futures are settled only for the net amount, which is gain loss, which means spot market position continue to remain with us, and it will also be required to be settled separately. Third point of learning, if there is an income, that should also be considered. Last is the net thing. Now let me teach you two more things in the concepts notes. If in the exam you face the question of arbitrage, then you can never do it wrong. Why? Meaning to say, in the exam itself, you can verify if the question is correct or incorrect, because the amount of arbitrage profit is always and always equal to the difference between actual and fair futures price. For example, in our case, the actual futures price is 122,500. The fair futures price is 121,437. So 122,500 minus 121,437. The difference is 1063. The amount of mispricing is 1063, and that is always equal to the amount of arbitrage profit. So if the amount of arbitrage profit is turning out to be different from the amount of mispricing, then you can observe that the profit calculation somewhere in the table is incorrect. You can verify in the exam hall itself first. Second, let me tell you, sir, when it comes to calculating the overall gain loss on futures, let me tell you the entire formula. Per future gain loss, you are clear inflow minus outflow. But one contract will have many such futures, yes, multiplying it with the contract size, and one contract, you can have not just one contract, you can have multiple contracts. So overall, this is the overall amount of gain loss you will have on a futures position when you do the net settlement. All right. Bhavya says, I am a fast track batch. Students really loved the lectures. Bhavya, thank you so much. When you all appreciate it, motivates me. That's great. Bhavya, have you watched the lecture of derivatives or not yet? Completed all your lectures? Are you able to connect to whatever is going on in the class right now? Is my question. So people, we are all done. We are clear with the concept of arbitrage, even if it is the net settlement. Fine. Question 10th boss gets done. Next question we gonna solve in the class is question number 14, for which you will have to learn the next concept. The next concept you should learn, everyone in the class, is the concept of hedging. It's very easy to revise like this. That's great. So please let your juniors know this. That it's really easy to revise from sir's notes. Taking all, everyone in the class, people, are we all there? Shall we all proceed? All the live people, we have learned what an arbitrage is. Now we're gonna learn what hedging is. What do we all say? People, are you all there? Shall we go on to learn the next concept? Come on, tell me. Live people, waiting for your responses. Where are you? Yes, Bhavya, thank you. Live guys, shall we all go on? You have been continuously watching, but I feel that some people are lagging behind. Dhwani, very good morning. Shall we go on? Come on. Now you're gonna learn hedging through forward futures. Now you're gonna learn something which will be of use to the entire derivative and to an extent even to the forex. Listen to what I'm trying to teach you now. Sir, what hedging is? 0 point, suppose you have gold. Very quickly, let me explain what hedging is. At 0 point when we stand, sir, suppose I have gold in my hand which I want to sell. Fine. Sir, this gold which I want to sell after 3 months, I am afraid what will be the share price. Right now the price of the gold in the market is 90, but on the day of expiry, what will become the gold price in the spot market? No one knows. It may become 95, it may go to 85. The price is subject to uncertainty, subject to risk. To eliminate that risk, what do? We enter into a forward contract today. I have entered into an agreement today with you that I will sell you the gold at 92 irrespective whatever be the price in the market. Correct? This agreement that I have entered into today, this position in the derivatives that I have taken today, what was the objective? The objective decides, what do you call it? In arbitrage, the objective was to gain profit through mispricing. Out here in hedging, the objective is to eliminate or avoid the uncertainty of the spot market. In the spot price, in the spot market, the spot price that it will become after 3 months is uncertain. To avoid that uncertainty to my life, I enter into a contract, because then I have a contract to sell you at 92. Whatever be the price, I'll be able to sell you at 92. I have avoided that uncertainty, is called as hedging. Yes. Taking a position in the derivative where the intention is to avoid any kind of loss which may happen to me in the spot market is called as hedging. Yes, boss. So hedging, if I take you back, the main way or broadly the mechanism of hedging is, today I am afraid of something. Today when I stand, I'm afraid of something, so I start to hedge. Right? Which means I have to take the position in the derivative to avoid the loss of the spot market. Whenever you think that the hedging is over, for example, I was holding gold. After 3 months, I sell the gold in the market. Am I worried now? No, the gold has gone. I'm not worried about the price fluctuation. When you're not worried, the hedging should get over, which means I should now settle all my positions. Today you take the position, on the day of expiry you settle the position, the hedging starts here, the hedging ends here. That's a simple scenario of hedging. How do you take position in derivative? You will learn now. How do you settle the position in derivative? You have learnt it already, the delivery settlement and the cash settlement. Yes. Sir, the most important thing which a lot of students, first either they get confused, or even if they don't have a confusion, they already have the clarity. It is a difficult way of thinking they already know. Let me simplify a way of thinking for y'all. The simplified way of thinking is learning the position to take through golden rule. It is not an official rule, it is something we have created for our class, but something which is going to be of great help throughout derivative and forex. Sir, the golden rule of hedging, which says do in derivatives today the same thing that you will do in the spot market on a later date. If you want to hedge, in order to hedge, for hedging, today you take the same position in the derivative market that you will take in the spot market on a later date. For example, imagine I am holding gold. I have a long position in gold today in the spot market. Do you agree? At some point on a later date, you will sell it. Yes. Today, if you are worried, today if you want to hedge, sell it in the derivative market today only, which means if I have a long position in the cash market, then in the futures and forward market, I should sell it, which means I should enter into a contract to sell gold, which means I should short future forward. If I have already a short position in something and I'm worried, I know at some point on a later date I will buy it in the spot market. So in order to hedge in the future forward market, buy it today only, take a long position. Sir, imagine you don't have a position already. You must be thinking that, sir, what you're saying seems more complicated, because we have learnt it very easy that we have to do opposite. If my position is long, do short. If my position is short, do long. My question is, what if you already don't have a position? What you have learned is correct but incomplete. What if I don't have any position? Sir, if I don't have a position, why would there be a gain loss? There will be a gain loss. Let me explain how. Sir, at 0 point, you don't have any position. You plan to buy gold after 6 months. Price of the gold in the market is 90. Are you not worried that the price after 6 months may become 95 or 110 when you are going to buy? Do you have a position? No. But do you have a worry? Yes, because I will take a position after 3 months. The position if you want to take is long. Golden rule says do in derivative today the same thing that you will do in spot. Today you don't have a position, but what are you planning to buy at on a future date? Why don't you buy it today only in the derivative? The position to be taken in the future forward today is long. This table tells you what position you have to take today. It is not always opposite. The position you want to take is long, then do long in derivative. Don't do opposite. Two possibilities. You already have a position and you want to take the position. If you want to short after 6 months, you don't have any position today, short it today only, you are all hedged. The simple golden rule will be of use everywhere except for one topic which I will tell you. This golden rule has one practical question very immediately, which is question number 14, which we're gonna right now discuss. Come on. Mr. V commodity trader specializes himself into the trading of rice. Rice, people, that you eat is the asset being traded. He has 24,000 kg of rice which is planning to sell after 3 months from now. He has rice. What position in your mind can you feel for it? Sir, the long position in rice. I'm planning to sell it after 3 months from now. Fine. The following details are available. Spot price, the price of rice today 1 kg 70 rupee. 3-month futures trading at 68, which means today I can enter into a contract to buy or sell rice after 3 months at a price of 68. Today is the price at 68. Contract execution happen after 3 months. Expected price after 3 months, I'm expecting that in the spot market the price of rice will become 68. Fine. Contract size rupee 500 kg per contract. You are required to advise interpret the position in the cash market. In the spot market, I have 24,000 kg of rice. My position is long. Fine. How to mitigate risk for fallen price, and next is how to use future market. The risk can be mitigated by taking a position in the derivative market. It is called as hedging. The risk of the spot market can be mitigated by taking a position in the derivative market. It is called as hedging. How to use futures market? Sir, if I have a long position, as per golden rule, I take a position today in the derivative to hedge. What position you take? Golden rule says do in derivative what you will do in the spot. In the spot, you will sell after 3 months. Why don't you sell derivative today? To the examiner, you don't have to tell all this. To the examiner, you will say, I have a long position in the spot market. I have a long position in the spot market. I should take a short position in the futures market. That's simple. Yes. Next, what will be the effective price realization? Effective price realization after 3 months if the spot price is rupees 69 per kg and 3-month future contract price is 72 and 67. Please understand the way or the mechanism of this question. Today, you already have a position in rice. That is your spot market. To hedge that, you take a position in the derivative market, which means you short futures of rice. So now you have got two things in your portfolio. On the day of expiry, you settle both the things and try to calculate the net realization. So let's settle them one by one. Rice, which I bought, for which I have, will be sold in the market at a price of 69. So at a price of 69, 24,000 kg of rice, when I sell, it gives me 16,56,000 rupee of inflow. Sale proceed from the spot market, sale of rice. Fine. Now let's think about the futures market. Sir, if the price of the rice in the market, the futures price in the market becomes 72. At 0 point, I entered into a contract at 68. At 68, I sold it in flow. On expiry, the price of the rice becomes 72. Now I square it off, I buy it, become my outflow. Inflow minus outflow is the loss of rupee 4. So 4 rupee loss, right? Let me simplify it for you. 4 rupee loss on a quantity of 24,000. 4 multiplied by 24,000 kg rice is 96,000 gain loss. Just 1 second. Just give me a minute. Just give me a minute. 1 second. 48 multiplied by 500, 24,000 into 4 is 96. Give me a minute. So 16,56,000 amount I will receive when I sell rice, but 96,000 is my loss in the derivative market, in the futures market. So how much is the net of both the market I will receive? 1656 is the inflow, 96 is my loss. So 1656 minus 96. So give me 15,60,000 is the net amount I will realize. Is the effective is the net of both the market, spot market and derivative market. Effective is the overall realization of my portfolio, which has a spot market position of rice, which have futures of rice which was taken at 0 point. Yes. Before learning to the answer, my question is specifically for this question is, are you understand it? What is examiner trying to ask to you? Come on. Yes. Sir, next is effective price realized, which means on a per unit basis, you will have to tell him. So overall 1560, if you realize on 24,000 kg of rice, per kg it is rupee 65. Per kg it is rupee 65. Similarly, if the price in the market becomes 67, please know it is a rectification. So people, please do rectify this and solve the second part of this question at your own. Question 14th, everyone in the class gets done. Such an easy question. To be able to solve the next question, you will have to learn the next concept, which is also related to the portfolio management. Let us proceed to learn, right? So let us take a quick 2-minute break. Let us take a quick 2-minute break before we go on to learn the next concept. Are you all fine with it, people? Till this point that we have learnt, are you people 100% comfortable? Come on, kindly respond. All the live ones, all the recorded ones, are we all settled? Let's now proceed to the next concept, but before that, let's take a quick 2-minute break. Let's meet back after 2 minutes. Then we learn the next concept and solve a lot of practical question of that concept. Cool? See you all after 2 minutes. So yes, people in the class, that 2 minute break is now over. Please, 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 everyone in the class be back, because we are now learning something which will have a lot of practical questions, literally a lot of and really great practical questions which you gonna learn with great clarity. Yes, people, come on, are we all there? Shall we start? So, if I talk about next topic, it is called as beta adjustment or hedging. Sir, how are these two topics even related? Beta relates to portfolio management, hedging relates to derivative, what is going on. Sir, in the derivatives, what have you learned? Hedging the spot market position. We learned that spot market position has a risk, has that uncertainty which is going to get hedged, right? Imagine in the spot market we have a portfolio, not a single share, but a portfolio of share. So that portfolio is also subject to risk, is also subject to uncertainty. And what is that uncertainty or risk called as? Beta is that uncertainty. So eliminating that risk is hedging, adjusting that risk is hedging, adjusting that risk is beta adjustment. This is how the two things are linked. Sir, how can you do it? Either you can do it using risk-free security or you can do it using index futures. Sir, index? Yes. For NSE, the index is Nifty. For BSE, the index is Sensex. So using the futures whose underlying is Nifty and Sensex, you can hedge or do the beta adjustment. Similarly, you can hedge using risk-free security. This particular part relates to derivative, this particular part relates to portfolio management, but you learn it here. Why? Because the practical questions are solved where both of these things are tested in a single question. Yes, so let's get started. Sir, when you talk about beta of the portfolio, right? Sir, let's think of some basics in the from the portfolio management. Guys, are you all there? I would strictly request you all to come to the latest point, the live point where the class is going on. Come on, people. We are getting started, people. Sir, what is the beta of a security or the portfolio means the interpretation? It means percentage change in the security or the portfolio value divided by percentage change in the market or the index first. Sir, when it comes to calculating beta of the portfolio, how do you do it? Beta of an asset into weight of that asset in percentage terms in the overall portfolio, beta of second security into weight of that security in percentage terms in the overall portfolio. That way you have the beta of the entire portfolio. If you don't have the percentage weights and if you have the market value or the absolute amount, then also you can do it. Beta of first security into the market value of that security in the portfolio. Second, beta of that security into the market value of another security in the portfolio divided by sum of all the market values, which is sum of these absolute weights. Logical? Basic? Fine. We will also go through the practical question. You will learn it better. My main objective was not to teach the formulas, but to teach the point of significance in these formulas. Please, everyone in the class, participate and tell me, can the beta of the security positive or negative? Can the beta of a security or the beta of the entire portfolio, can they be positive and negative both? Yes, sir. You have taught it in the portfolio management. When the beta is positive, it is same direction. Beta increase, value of the portfolio increase. Beta, my bad. When the beta is positive, market increase, value of the portfolio or security increase. Market decrease, beta of the security or portfolio decrease, which means it has the same direction. However, if the beta is negative, it is opposite direction, meaning to say negative beta means opposite direction. Market increase, security or portfolio decrease. Market decrease, security or portfolio increase. That's how the negative beta is, which is fine. My more important question to you all, can the weight or the market value of the securities be positive, negative both? Can the weights ever be negative? The answer is yes, yes, big yes. Sir, why? When you take a long position in any security, the weight is positive, market value is positive. When you take a short position in any security, the weight or the market value, people in the class, is negative. Yes, yes. Sir, beta of cash or risk-free security is 0. Beta of market or index futures is considered 1. Perfect. This was all the basics that we have learnt in portfolio management. I'll take you to the next concept, which will give you a great conceptual clarity and its easiest application to the practical question. Come on. Sir, I already have a portfolio of say 1 lakh rupees. It has a beta of 2 times. So beta of my existing portfolio is 1 lakh rupee. The value of an existing portfolio is 1 lakh rupee, and it has a beta of 2 times. Correct. Now, I find it to be really risky. I want to adjust the beta. I want to change its beta to 1 time. My target beta which I want to achieve is 1 time. To do this, there are two possibilities. One, either you make use of risk-free security, another you make use of index future. First, learn everything about risk-free security, solve a practical question, then we go to the index futures. Yes, pay attention, very interesting, you will enjoy it. So, at present, I have a beta of 2 times of this portfolio of 1 lakh rupee, which I want to make 1. Can I say a simple common sense will be, right now 100% of your amount is invested in a risky asset whose beta is 2. Of this entire 100% portfolio, if you invest some amount in risky security and rest of the amount in a risk-free security which has no risk, which has no beta, so can I say the overall average of two category, risky and risk-free, the overall average beta of the two securities or the two categories can become 1. It can reduce down your beta from 2 to 1 if you invest some amount in the risk-free security. Yes or no? The question is asking you what percentage I should invest in risky asset and what percentage in the risk-free asset so that I can convert my beta to 1. It's a common sense. Sir, think about weighted average. My overall portfolio now has two categories, risky asset and risk-free asset. Beta of risky asset into beta of risky asset plus the beta of risk-free asset into the beta of risk-free asset should give me the overall beta that I want. This beta of the overall thing should be what I want, which is 1. At present, the beta of risky asset is 2 times. Then in my portfolio, it should have some weight. What weight it should have, that I don't know, I will have to calculate. Similarly, the beta of risk-free asset into the weight of risk-free asset should be 1. The weighted average beta should be 1. I want to back calculate. Listen to this. Why am I applying this formula? I want to find out that right now my overall portfolio beta is 2. If I want to make this overall portfolio beta as 1, what should be the weights of individual risky and risk-free asset to make the overall beta as 1? That is what I want to find out. So, sir, if I want to make the beta as 1, I will need to back calculate the weights using this equation. Sir, this entire terminology becomes 0 because beta of risk-free security is 0 and 2 multiplied by beta of risky asset if it is 1, then 2 multiplied by the weight of risky asset if it is 1, then weight is equal to 1 divided by 2 as 50% and the risk-free asset is 1 minus 50% as 50%. Please understand, beyond formula is the understanding or the background of this topic. So you have learned that right now your 100% investment is in the risky asset whose beta is 2. If you want to convert it to 1 time beta, you should have 50% investment in risky asset and rest of the 50% in the risk free to achieve the target beta of 1. It seems easy and logical. So step number 1 is to reverse calculate the ideal or the target weights. And the step number 2 is to find out the amount of risky and risk-free. The amount of risky and risk-free I need to find out using these weights, which has two possibilities. Try to understand the two possibilities, which is all common sense. Sir, this 1 lakh rupee entire portfolio, I bring it here. 50,000 rupee, listen to me, in this entire 1 lakh rupee, 50,000 risky asset if I sell and buy the risk-free asset of the same amount Can I say now in that 1 lakh rupee, 50,000 continue to remain risky, and rest of the 50,000 I have bought risk free? That's how my total portfolio has a weight of 50-50%, and that's how the target beta of 1 can be achieved. 50% portfolio, which is 50,000 rupee, 2 time beta. 50,000, 50% portfolio, which means rest of the 50,000 rupee has 0 beta. The weighted average is 1. Are you finding it logical? Yes, sir. Another possibility. If I have 1 lakh rupee already invested in something, the second option says let this 1 lakh rupee of risky asset continue to remain 1 lakh rupee of risky asset. Sir, if you want to make it 50%, then you bring additional 1 lakh rupee into the portfolio. Additional bring in 1 lakh rupee into the portfolio, which means now the risky asset continue to remain 1 lakh, but the overall portfolio become 2 lakh, which is why again the risky asset become 50 and rest of 1 lakh become 50% as my risk-free asset. And if you realize, the 50-50% target weight has been achieved and the overall beta of portfolio of 1 has been achieved. Could you all please observe that this 1 lakh rupee of risky overall portfolio, which is risky asset existing 1 lakh rupee, can be converted to 50-50 in 2 ways. One, you sell the part of the portfolio, buy the risk-free security for the same amount, making it 50-50. You let that 1 lakh rupee as it is, you bring in additional 1 lakh rupee to make it 50-50. Come on, people in the class, could you connect to what I said? Please tell me. The point is, sir, how do you figure out which option to follow in the exam? That language of the examiner tell me that we do it in the class right now today. We will do it. Second, sir, what is the exact way to solve a practical question? That I will teach you when we go to the practical question. But in terms of concept, could you understand? First, you have to find out the ideal percentage. Then you have to find out the ideal or the target amounts, which has 2 possibilities. If you all are aligned, let me take you to the practical question, just 1 point of learning. In the portfolio management, I had taught you that when you take a long position in any security, it has positive weight. When you take a short position in any security, it has a negative weight. Agreed? So if the answer of weight that you calculate turns out to be positive and negative here, if the answer is positive, you have to take a long position in the risk-free security, and if the answer is negative, you have to take a short position in the risk-free security. If the answer of risk-free is positive or negative. Yes, boss? So let me take you all to the practical question where you'll be able to relate to this. Sir, after 14th, the next question we have to solve is question 16. Question 15 is also there from the study material, but it is an ambiguous question. I will explain that to you later. Before that, let me explain to you question 16. Come on. Portfolio manager has 4 stocks in the portfolio. 4 stocks. Number of share is this. Market price per share is this. Beta is this. Calculate portfolio beta. Needless to mention, number of share into the market price give you market value. And market values are being used as weights. So beta into the weight give you weighted average beta. The beta of the portfolio turns out to be 1.108. We are not focusing on calculating weighted average beta of the portfolio. It is 1.108. Fine, sir. Sorted. Next, if PM seeks to reduce the beta to 0.8, if portfolio manager seek to reduce the beta to 0.8, how much risk-free security should he bring in? Look at the word. First, look at the question. Sir, let's try to fit the concept in the question so that we have a stronger understanding of the concept. Come on. PM seek to reduce the beta to 0.8. Presently, the beta is 1.108. We want to reduce the beta. Can you all feel the beta adjustment? My beta is getting adjusted. Can you all feel? Yes. And using risk-free security, you have to do the adjustment. Try to relate the out notes with the out scanner. And using risk-free security, you have to do it. Which category in the risk-free security? Sir, additional investment you have to bring in. Option 1 or option 2? When they say bring in, it is option 2 people in the class, because new investment is to be brought in the option 1. You sell something and you buy something, there is no new bring in option 1. Sir, I want to make you people observe something out here. Please observe something. Sir, what is that something? Let me tell you. Let me tell you. Everyone. Sir, so if you observe in option 1, my overall portfolio of 1 lakh continue to remain 1 lakh, but the risky asset in that changes. So I want to make you observe what continue to remain same and what changes. The risky asset of 1 lakh changed to 50, but the overall portfolio continue to remain 1 lakh. Option 1. Option 2. Risky asset of 1 lakh continue to remain intact as 1 lakh, but the overall portfolio of 1 lakh changed to 2 lakh. Correct? In option 1, portfolio remain intact but risky asset change. In option 2, portfolio change but risky asset of 1 lakh continue to remain intact. This is the difference between the two options. My point is, if you want to solve it, if you want to solve any question, start with what remains intact. Sir, what do you mean by start with what remains intact? I will tell you in a practical question that we are going to. Sir, I want to adjust the beta where I want to bring in the security. Fine. PM seek to reduce the beta to 0.8. Everyone, let's first of all find out the percentage weight. Then will be the possibility of option 1, option 2. What are the percentage weights? Sir, at present the beta is 1.108. So beta of existing asset into the weight of beta of risky asset into the weight of risky asset plus beta of risk-free asset into the weight of risk-free asset should give me the target beta of 0.8. So with this equation, I'll be able to find out the ideal weights I should have to achieve the beta of 0.8. When we calculate it, it becomes 0. So ideal weight of risky asset becomes 72.2 and ideal weight of risk-free becomes 27.8. Now converting them to amount using option 2. Do you agree in option 2, the risky asset remain intact? In option 2, the risky asset remain intact. So you start with the percentage and amount of risky asset. Sir, 72.2% is the percentage of risky asset and the amount of risky asset is 12 lakhs. So if 72.2% is equal to 12 lakhs, if that is intact, that is fixed, if that is equal to 12 lakhs, then how much is 27.8% equal to? Can you feel the unitary? Sir, it is 12 lakhs divided by 72.2 multiplied by 27.8 as 462,050 as the amount of risk-free asset. Since the answer is positive here, the answer is also positive here, the position you should take is long. You should long risk-free security of this amount to make your overall beta as 0.8. Easy, basic. Sir, if the PM seek to increase the beta, how much should he risk-free should he bring in? This time the weighted average I want to make. This time the weighted average I want to make is 1.2. So 1.108 is the beta, has some weight, and 0 beta has some weight. To make the weighted average as 1.2, how much should the beta of risky assets be? This becomes 0. When I solve it, the weight becomes 101.083, which means 108.3%. Weight, can it be more than 100? Yes, because the weight of one security is 108.3%, then the weight of another security is negative 8.3%. If the negative weight, it means it is an indication of short position. I said, start, the practical question tip is really important. I said, calculate the value of risky and risk-free asset. Start with the weight and value of what is intact. This line solves your entire practical question. Sir, look at this. Sir, the weight of see, what will remain intact? The risky asset remain intact. So start with the weight and value of what is intact. If 108.3% is equal to 12%, risky asset is equal to 12 lakhs, not percent lakhs. 108.3% is equal to 12 lakhs, then negative 8.3% is how much? Common sense. So 12 lakhs divided by 1.803 into 8.3 negative is equal to 91967. 91967 negative. So we should short risk-free security of 91967 people in the class, being the answer of C part of this question. That is question number 16. Simple point was start with what is intact. Option 1 of this category we will solve in the class today, but in a later question. For now this concept gets done. Yes boss, simple process and understanding you have. Next concept is using index futures you have to adjust the beta. Boss, waiting for your responses. Are you all there? Shall I proceed to take you to the next discussion? Come on, tell me. Are you people settled with the concepts that are going on, with the questions we are solving? People, come on, tell me. Shall we all go ahead? Sir, again you want to adjust the beta. Yes. Are we all really set? Come on, live people, recorded people, please respond. Sir, adjusting index futures. Come on, people. Sir, using index futures, adjusting the beta, which means today I have a portfolio of the same 1 lakh rupee having 2 times beta. If I want to adjust its beta, I will also have to take some position in the index futures. The question is what position to take, long or short, and how much position to take to do this beta adjustments is the question we are trying to answer. Similarly, even in the risk-free security, we had the same question, what position to take and how much risk-free security. Similarly, what position to take and how much index futures. Sir, the formula is here. The value for which the futures you should take today depends on what is the value of the portfolio you want to hedge. Your existing portfolio of 1 lakh rupee you want to hedge? Yes, sir. Fine. What is the beta you want to make? Target beta. Do you want to make it 0, 100% hedging? You want to make it 0.5 or 0.8? What do you want to make? Next, what is the present beta of the portfolio? For example, in our question, in this situation, it is 2 times of present beta. Yes, people? So this tell you what is the value for which futures you should take. Now, when you go to the market to take the future, every single futures is not available. There is a contract size. So we need to find out the number of contracts that we need to take. So if I have the total value of futures to be taken, if I divide it by price per future, so I will get the number of futures to be taken. So I know that I have to take a total value for rupee 1 lakh. The value in the futures to be taken is 1 lakh. If every futures is 1000 rupee, how many futures will you take? Sir, I will take 100 futures. But you cannot take one future. There is a contract size of 5 quantity. So I need to take 100 futures. In one contract, if I can take 5 futures, how many contracts should I take? Divide it by further 5 to get 20 contracts. This simple formula give you the number of contracts. Some of you might have been doing it as beta of the portfolio minus beta target. But that is not the formula you will have to use in our class. It is beta target minus beta portfolio. Sir, why? Because this formula again has a beauty. If the answer to this question is formula is positive, means you will have to take a long position in the index future. If the answer to this is negative, means you'll have to take a short position in the index futures. Right? Let's now understand it more clearly. Sir, what is value of the portfolio mean? What is the total portfolio of risky asset at present you have that you want to hedge? The existing portfolio of risky asset you want to hedge. Can this portfolio be positive and negative both? Obviously. If the position overall is long, it is positive. Overall position short, it is negative. Next, can the beta portfolio can be positive, negative? Yes. Can the beta target be positive, negative? Yes. Sir, what about the price of the future? Actual futures price today in the market on the day when I want to hedge. Today, whatever is the actual futures price is used. If the actual is not available, the examiner will give you the spot price and the R and the end, which means examiner will give you the details to apply cost of carry. So you can find out the fair futures price using cost of carry and use it as actual futures price, and the multiplier is always available. Which means once you find out the number of contract, you will get the answer as positive, negative, using which the position gets decided. Next, sir, suppose the contract is 4.97. Can you enter into a 4.97 contract? No, either it is 4 or 5. So you will round it up to 5. Sir, if it is 4.23, you will round it off to 4. Next thing. Sir, suppose the position has been taken today, right? Now, in the question, it will tell you, it may tell you that justify if the beta has changed or not, justify if we have been hedged or not. So you'll have to apply a simple logic that when the hedging start, you take the position. When the hedging gets over, you settle the position. So you have, after the position has been taken, you have now two positions. The original portfolio of 1 lakh rupee and the index futures position that you've taken here, either long or short. So these two positions, spot market and derivative market, when you settle here, you will be able to justify the hedging. As we go to the practical question, you will realize what I'm trying to say. Last point that I want to explain to you is that, as I said, the golden rule applies to the entire derivative except for one point, where the position to be taken in the derivative is not decided by golden rule, is this particular formula, because here we have our own rule that answer is positive long position, answer is negative short position. Except for this particular place, entire derivative and forex, wherever there is hedging, there will be the golden rule. Yes. Here you have positive, negative, which is aligned to the risk-free security to make your learning easy. Let's solve a practical question of this type and you will automatically understand how easy it is. Question number 19. Come on, everyone. Yes, come on, come on, come on. Please. 1st July 21, Mr. P has made following investment. Company share 1000, beta 1.25, share price 700. My overall portfolio value becomes 7 lakhs. Wants to hold the portfolio till September 21. Right now it is 1st July. Because I am expecting huge dividend on the date of investment, September Nifty future. Please observe which category of the concept you are in. Try to relate the question with the concept. I am in the hedging concept. I am using futures which are based on Nifty, which means using index futures, I want to hedge in this question. That's how you realize which category of the entire topic of derivative, which concept in the entire topic of derivative you are in. Sir, the futures price right now in the market is 17,500, lot size is 50. Please advise how to hedge. So we say value of the portfolio is 7 lakh. Fine, 7 lakh. Beta target is 0 minus present beta of the portfolio is 1.25 divided by price per future divided by multiplier. Please do solve it on the calculator and give me how many contracts. What are you getting as the answer? Sir, 0 minus 1.25 is 1.25 negative. Multiplied by 7 lakhs. Divided by 17,500 divided by 50 gives me minus 1 as the answer. It means when it gives me minus 1 at answer, it means one contract short. Only writing minus 1 will not get you marks. To the examiner, you need to explain. To the examiner, you need to explain that I want to short one particular contract of Nifty futures. Sir, at what price will you short? Whatever is the price today. Fine. Calculate profit to Mr. P on expiry. Today you took the position. On 7 lakh portfolio, you took one future short position. Fine. On the day of expiry, this will change, this will change. Some will have gain loss, another will also have gain loss. What is the net is what they are trying to ask. Fine. So sir, find the profit loss on expiry September 25 in the following situations. If Nifty future rise by 10%, apply common sense. You had short one contract which rise by 10%. So sir, if short position rise, I have a loss. Sir, what is the value for which position was taken? Sir, I had taken overall one contract where each contract has a quantity of 50 futures and where each future has a price of 17,500. When this entire value rise by 10%, how much is the gain loss? 17,500 into 50 into 1 into 10% is 87,500 loss. So will I have a simultaneous change even in the spot market position in my portfolio? Yes, let's apply common sense. Nifty future rise by 10, which means Nifty also rise by 10. If market rise by 10, your beta is 1.25, you rise by 12.5%. Yes, sir. So if my portfolio of 7 lakh on which I have a long position rise by 12.5%, so 7 lakh multiplied by 12.5% give me 87,500 as my gain. So this is my loss, this is my gain, and overall impact on my portfolio is zero. I want to justify that I have really hedged. I had a risk in the spot market. To eliminate that uncertainty, that risk, I took a position in the futures market. And after that position, if I look at my overall portfolio, which has both the things, I see that there is no gain loss. I am completely hedged. That was part A. Part B talks about 5% sell in fall in shares that you can do at your own. Part C is theory that you can do at your own. Could I please justify how 19th question is working here? Were we all able to apply the concepts that you have learned in the practical question 19? I need a response from every single student sitting in the class. Please, 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 people tell me. I need a response. Come on. Are you all able to connect? One particular question that we missed is question number 15 that we would want to solve right now. Super fast, it is a question that we need to discuss in the form of LDR. Come on, come on. A trader is having does not relate to any particular concept. It relates to, in general concepts, the basics of portfolio management here. Come on, people, we are learning, we are proceeding with it. Come on. Sir, unfortunately, I have a very well prepared timeline of our handmade notes that we follow in our regular batch. Right, I'll show you how simple the question due to timeline become. A trader is having in its portfolio share worth rupees 85 lakh at a current price and cash 15 lakhs. In my portfolio, what do I have today? 85 lakh long position, 15 lakhs cash. Beta of share is 1.6. This has a beta of 1.6. After 3 months, share price dropped by 3.2. Okay. So we have the information today and we have also the information after 3 months. What is the current portfolio beta? Easiest question. 1.6 is the beta for 85% of the portfolio and 0 is the beta for 15% of the portfolio. Weighted average turns out to be 1.36. Easy. That's not the main question. Second question, the main question, determine portfolio beta after 3 months. If trader on current date goes long position in 100 lakh Nifty futures. Please understand what this question tries to say. Let me open my annotated handmade notes. So these are right now future forex. So please observe, this is how we do it in the regular batch. I mean all the questions are presented on the timeline, making your learning the way you are learning from the outnights, right? Everything is timeline based. A similar thought process we have even for the practical question, but right now I need to go to the derivatives. Wait. This question also we're gonna do in the class today. Really a great question. Right now, this question we're gonna do. Come on. Making your entire question easy with your imagination, Let's learn it, people. We need to find the portfolio beta after 3 months. So the first ambiguity in this question is that even if they say that find the beta after 3 months, they have calculated the beta of today only. That is the first ambiguity. Listen to me carefully. Second, sir, whenever in the entire question, whenever examiner give you any change in the share price or in the market or in the Nifty, wherever any change is given, please understand that it is a hint. It is a hint that you will have to apply change by change formula to calculate beta. A very important thing I'm saying. Examiner give you the hint of change in market or change in the share price. Make sure that you take it as a hint that I have to apply change divided by change formula. Sir, in our case, please know what's happening. Look at this. Sir, portfolio beta after 3 months you have to find, but it is 0 point beta. If trader on the current days goes long position, sir, right now I have a share of 85 lakhs long, I have a cash of 15 lakhs long, and I have a Nifty future of 100 lakhs long, 100 lakhs long. What is my total portfolio value? You might think 85 plus 15 plus 100 is 200, but let me tell you, my overall portfolio value is only 100 lakhs. When you take a Nifty futures position, do you end up investing anything? No, it is just the contract that you enter into. Value continue to remain 100 lakhs. Fine. Now I have to find out what will be my value after 3 months. Sir, let's take it one by one. Share drop by 3.2%. So 85 lakh when drops by 3.2%, it become 82.28 lakhs. Sorted, sir. Cash beta is 0. Due to change in market, there is no impact on cash. It will continue to remain 15 lakhs. Sir, Nifty futures which were of 100 lakhs, will they change? Yes. Share changed by 3.2, which had a beta of 1.6. So due to change in share, change in share is 3.2 negative. Beta is 1.6. So there would be some change in the market now. When you solve it, you see that the market changed by negative 2%. So market means Nifty changed by negative 2%, which means Nifty futures changed by negative 2%. Sir, which means 100 lakh Nifty future become 98 lakh after 3 months. So Nifty futures value is not counted in the portfolio value, but its gain loss is counted. 100 lakh I took a long position. After 3 months it became 98. When you buy, it is an outflow. When you settle something, you have to sell it, then it will become inflow. Inflow minus outflow give you 2 lakh rupee loss. Point is, this is not in the value of portfolio, but 2 lakh rupee of loss which has happened, I'll have to pay cash from my pocket for it, which is why the 15 lakhs cash after 2 lakh loss become 13 lakh cash. So this entire portfolio after 3 months become 82.28 and 13 lakhs, making the total as 95.28 lakhs from 100, which has also effect of change in the futures price in it. Sir, how much is the percentage change which has happened? Sir, 4.72%. So do you people agree? Change in the value of portfolio is 4.72%. Due to 2% change in the market, fall is 4.72 due to 2% fall in market, giving me a beta of how much? 2.36. Although it says that calculate the beta portfolio after 3 months, but please let me tell you, change by change give you the beta of today only. 2.36 is the beta of today only. Just that you have to calculate it by change formula, because examiner has given the information regarding change. Could I please explain to you 15th question, which has got no relation with the beta adjustment topic? 15th question gets done. 19th gets done. The next question is question 21. A really brilliant question, super fast we're gonna do in the class. Please. 21 question. Really a great question. People, come on. Sir, are we all ready? Shall we all proceed? Sir, Ram buys 10,000 share of X Limited at a price of 22, whose beta is 1.5. Sells 5,000 share of A Limited, whose price is 40 at a beta of 2. Sir, what all information is given? position, long and short. Quantity of share 10,000 and 5,000, price per share 22 and 40, and the beta is 1.5 and 2. He obtains a complete hedge by Nifty futures. Complete hedge means making the target beta as 0, right, at a rupees of 1,000 each, which means I make use of Nifty futures. Can you connect to which topic of derivatives we are in? Nifty futures is being used to hedge a portfolio where the price per future is 100 each. He closes out a position at a closing of next day. Today I had X and A. I also took Nifty future. On next day, I close all my position. When I go to the market to close the position, I see that share of X Limited dropped by 2%, share of A Limited appreciated by 3%, and Nifty future dropped by 1.5. Overall profit loss we have to calculate. It's an easy question, right? You have to simply think of the gain loss. The problem is, overall value of A you have is 10,000 into 22 is 2,20,000. Overall value of X is 220 as we learned. Value of A is 5,000 into 40 is 2 lakhs. But overall value of Nifty futures we don't know, we have to calculate. Sir, 220 long, 2 lakh short is negative. My portfolio value is not 4 lakhs 20,000, it is just 20,000, the net number. Fine. This is the value of portfolio I need to hedge. And what is the beta I want to hedge? Present beta. Sir, beta into market value divided by sum of market value. When you solve it, please observe the market value here will be negative, here will be negative. Overall weighted average beta is 3.5 negative. 20,000 portfolio has 3.5 negative beta, which I want to make 0 using index futures. So how many contracts will you take? Sir, 20,000 is the value multiplied by 0 minus beta target. Sorry, 0 target beta minus beta of the portfolio whole divided by, sir, one contract has a 1,000 rupee value. It includes the price per future into the quantity per future. 100 is the overall value. So how many number of contracts you will have to take? When you solve it, you get positive 70 as the answer. Sir, negative and negative become positive. 3.5 negative multiplied by a negative number become positive. So 3.5 multiplied by 20,000 divided by 1,000 give me plus 70 as 70 contracts long. Are you understanding? If you don't have that logic of positive negative, please imagine how would you solve this question? Because if you do beta portfolio minus beta target, the answer to this will be negative. And how would you then remember whether to take a long position or a short position? Sir, the formula that we do in the class is universally applicable. Yes, long position. So now I know I have this, and I have this. What if all this position change next day? Sir, X long, A short, futures long. Value I have taken is this. I have taken 70 contract of 1,000 is 70,000. Sir, when 220 on which I have a long position fall by 2%. So 2,20,000 into 2% is 4,400 loss. 2 lakh rise by 3%, but I have a short position, again loss 6,000. 70,000 long position, which drops by 1.5%. Long position drop is again loss. So 70,000 into 1.5% is 10 lakhs. Sorry, 1050. My overall loss is 11,450. You all might think that, sir, why is hedging not working? This is giving me loss, this is giving me loss. Why is futures not giving me profit? Because the change is not according to the beta. When market changed by 1.5, due to 2 times beta, share should fall by 3. Market dropped by 1.5 due to 2 times beta, share of A should drop by 3. It rather increased by 3. If it would drop by 3, I will have a gain of 6,000, not a loss. Since the price in the share is not as per the beta which is given in the question, which is why the hedging could not successfully happen. That was question number 20 when I wanted to explain in the class. Boss, are you all please able to connect? Tell me. 21st gets done, 21st gets done. 24th question. So one more thing. 22 is a question institute asked in the exam of November 24, which is a reverse calculation based question which you all must do, right? 24th is the next and very interesting question we're gonna do in the class. People in the class, please be here. We complete this entire topic of forward futures, then we go for a break. Is that people in the class, please fine? Will you be able to sustain and survive for the next 20-30 minutes? Please tell me. Question 24. What a brilliant question. Let's solve it in the class. Sir, BSE. The BSE is 5,000. So the Sensex, everyone in the class, is 5,000, meaning to say the spot price of BSE is 5,000. Next. Value of the portfolio that I have is 10,10,000. Risk-free rate 9%. Dividend yield 6%. Beta is 1.5. I don't know what all is given. This information relate to hedging through index futures. This relates to index future hedging, but this relates to cost of carry model. I don't know what this question has to do. Let's see. Dhananjay says power, sir. Power batch kab release hoga? Which power, Dhananjay? Which power batch? Sir, we assume that future contract on BSE index with 4-month maturity is used to hedge the value of the portfolio over the next 3 months. What a line! What a line, people. 24th question. Read the line again. I'm giving you 2 minutes. Read the line again. Come on, super fast. Power batch for Hindi, Dhananjay has already taken. Power batch for English has already been taken in the last 2 months. Both the power batches have been taken live. Come on. Oh, for your friend. Now the recorded is there, live will be somewhere there in the next 6 months. Everyone, have you all read this line? What it says? We assume that the future contract on BSE index with 4-month maturity is used to hedge the value of the portfolio over the next 3 months. One future contract is delivery of the 50 times share. It means that listen to the situation very carefully. Sir, at 0 point I stand. At 0 point I have with me the portfolio of 10 lakhs 10,000. Fine. I want to hedge this portfolio. For 3 months, I want to do the hedging, which means I may be planning to sell the portfolio here. So when you want to start the hedging, you take position in the derivative. When you feel that the position in the when you feel that the hedging is about to get over, you settle the position of derivative. So today you want to start hedging. So you took a position in the index futures. What position did you take? Future contract on BSE index. Automatically you should realize which topic. Futures contract of BSE index is being used to hedge with 4-month maturity, is used to hedge the value of portfolio for 3 months. So I want to hedge for 3 months, but for hedging the portfolio that the futures that I will take here will expire after 4 months. Okay, fine. Let's see what happens. One future contract is 50 times the delivery of index. What is the price of future contract? Sir, when you want to hedge using index future, you need the formula of value of the portfolio into beta target minus beta of the portfolio divided by price of futures and so on. Has the price of future been given to you? Has the price of future been given to you? No, sir. The spot price has been given. The futures price can be calculated using cost of carry model. So let us calculate that first. Sir, please observe, you need to apply cost of carry. Please go back to the older topic. You identify the spot price. Yes, sir, it is there. Then you identify the interest rate 9% per annum, category 3 because no compounding frequency given. 1 plus Rn is the formula. Dividend yield has been given, which means 1 plus R minus Yn is the formula. So spot price is there, I is there, Y is there. What about N? What is my N? 3-month for which I want to do the hedging, or 4-month which is my time period till expiry. Everyone in the class, it is 4-month. Yes, do you understand? So come on people, spot price of 5,000 into 1 plus R minus Y, which is 9 minus 6% into N is 4 divided by 12. When you solve it, the price of the futures today is 5050. First part, really easy. Second part, the main thing, the main interesting element, come on. You need to calculate the gain on short futures position if index turns out to be 4500 in 3 months. Sir, please read the line at least 2 times. I need to calculate the gain on the short future position. If index or index futures, sir, index, the spot market position after 3 months turns out to be 4500. Please listen to me, please look here. So the spot price which is 5000 here, if the spot price of the index turns out to be 4500, what is the gain loss? But gain loss on index? No, gain loss on the futures. But why will you take futures? Arey boss, you wanted to hedge. So in order to hedge, you might take some position. Examiners say you are taking short position. Okay. An examiner also say on that you will have gain. So first of all, let's apply the formula of hedging through index future and figure out if we are actually taking a short position or not. And what is the quantity for which we have to take the short position to hedge this 110 portfolio. Fine. Today, I take the position where the futures price is 5050. Sir, how much contract? Value of the portfolio into beta target minus present beta of 1.5 divided by price per future. We just calculated as 5050. Fair has been assumed as actual divided by contract size 50. When you solve this equation, answer is -6, which means 6 contract short you have to take. Examiner was really correct that I have to take a short position. Fine. But now the examiner says you will have a gain on it. Is it correct? Let's check. Sir, at 0 point, I had taken a short position on 6 contract at a price of 5050. After 3 months, I want to settle it. For settling then, I need the futures price. If you buy future, if you sell futures, in order to settle, you need the futures price. Can you please imagine convergence chart that we read? Yes, sir. Do I have the futures price given to me in the question so far? No, sir. No. We have been given the spot price of 4500 after 3 months, not the futures price. But sir, okay, let's assume convergence. You can't. Why? Expiry is at 4 months. The convergence happen here, not at the end of 3rd month. At the end of 3rd month, spot price is different and futures price is different. I need futures price to compare with futures. Sir, do I have the spot price? Yes, 4500. So can you apply cost of carry model again to find the futures price and to calculate the futures price? Yes. Let's apply the futures price calculation formula again, because a spot cannot be compared with futures. Those are small conceptual clarities that you have learned in the outnotes. Are you able to apply them here? Yes. This is why I specifically taught you that when you settle something before expiry, you need to have the futures prices specifically ready if you want to do the net settlement, if you want to calculate the gain loss. So if I have the futures price ready with me, at spot price ready with me, let's calculate the futures price. Let's apply the cost of carry model again. Sir, now please observe one more thing. The futures price of this day will be based on the spot price of this day, not this spot price. Learning number 1 that you had previously, applying it. Learning number 2, now the time to expiry is just 1 month. If I have people, sir, 4500, today's spot price, which means 3rd month's end. 1 plus R minus Y into N is just 1 by 12, giving me the futures price of 3rd month as 4511. 4511 is the futures price. You took a short position, selling is inflow. To settle it, you have to buy it back, giving me a feeling of outflow. An inflow minus outflow is the gain loss on 6 contract having a quantity of 50. Overall, boss, it is a gain to me of 1,61,625. Boss, examiner was very correct. Gain on short futures position if index turns out to be 4500. You had to give the gain only on the futures position, not the overall gain loss. Such a brilliant question, people in the class. This is, if you observe, what all have you learnt in this question? First, examiner give you a portfolio. To hedge, you need the actual futures price, but it may not give you actual, it may give you a spot and the rate and the yield and the time period. You may calculate fair, assume it as actual, and then hedge. First learning. Second learning, if the hedging is for 3 months, the contract is for 4 months, you should have the conceptual clarity that to calculate the fair forward price, fair futures price, you have to take time till expiry and not the time till hedging. Third, you take a position for which you applied a formula. The position is to be settled if it is before expiry. Don't assume the given spot price to be futures, because convergence happen on expiry, not before expiry. So you have to first calculate futures price. For that futures price, the base will be the spot price of that day, not the previous spot price. And once you have the futures, you do the net settlement like this. This is concluding what all you had learned previously and applying to this question 24. Just a word I want to make you understand. If the index turns out to be 4500, index is the spot market thing, not a futures market thing. Question 24th gets done. The next question that we solve is question 26. Super fast, everyone in the class, please be here. Literally super fast. Right, just give me a second. Come on. Everyone, please. 26th question. The following data relates to A Limited's portfolio. XYZ, number of shares 684, price per share 1000, 1500, 500, beta is this. So basically I have 3 shares, number of share, price, beta given. CEO is the opinion that portfolio has a high risk compared to market and wants to reduce the systematic risk to 0.95, which means wants to make the beta to 0.95, has 2 options. Dispose of a part of risk existing portfolio, acquire risk-free security. Let's go back to the concepts. Sir, they are asking you to adjust the beta to 0.95. Can you feel it is the question of beta adjustment? Which can happen in 2 ways. One, using risk-free security. Second, using index futures. That is what is happening in this question. Using risk-free security, when you hedge, examiners say dispose of a part of risk existing portfolio to acquire risk-free security. Sir, option 1 or option 2? My total portfolio value going to remain intact, but in that total a part I am going to sell so that I can buy risk-free security. Sir, it is option 1 if you realize. And an alternative to hedge was take appropriate position in Nifty futures trading at 8250. Each point is 210, which means multiplier is 210. You are required to interpret whether he is correct or not. He is correct that the overall risk is very high. Why? Because beta of market is 1, and compared to market all my securities have higher beta, so obviously my risk is higher than market. Calculate the existing beta of the portfolio, existing systematic risk. It gives you market value, and beta into market value, when you do weighted average, beta into market value do weighted average, you get the beta of 1.4. Now the story starts. Advice value of risk-free security to be acquired. People pay attention. What it says, you want to change the beta of 1.4 to 0.95. For that, you have to sell a portfolio of risky asset and acquire risk-free asset. What is the value of risk-free asset you will acquire? First, we have to find out in percentage terms the ideal weight. I have an existing portfolio whose beta is 1.4. Into it should have some weight, plus the beta of risky asset into it should have some weight to get the overall beta of 0.95. Sir, 0.95 is equal to weight of risky asset into its beta of risky asset into its weight, plus the beta of risk-free asset into its weight. When I solve it, the overall weight turns out to be risky asset should be 67, risk-free should be 32. Now to convert it to the amount, I realize it is option 1. Sir, what are you saying option 1? Let me show that to you once. Come on. Sir, this is my option 1, where total portfolio value remain intact, but the composition of risky and risk-free in it changes. Sir, I said start your answer with what is intact. Total portfolio value. How much is the total portfolio value, sir? When can I calculate the market value? It is 20,000. So total portfolio value remain intact. So start with the amount and percentage of total. That, sir, if 100% is equal to 20,000 of my total portfolio value, then 67% is how much and 32% is how much? Sir, 20,000 multiplied by 32.14% is 6428 is the amount for which I need to acquire risk-free security and sell my risky asset. Start with the percentage of what is intact, and that is what we have done. Sir, part number C gets done. Part D, advise the number of each share to be disposed of. When you acquire 6428, you will have to sell your existing share of 6428. Each share, how many shares will be sold? So first of all, you have to find out that 6428 when sold, in what proportion each of the share will be sold? Sir, in their original weights. I see the original weight, everyone, is 30, 60 and 10%. So 30, 60 and 10% when you sell 6428, it is like 1928 you will have to sell for the first security, 3556 second and 642 third security. Is the amount for which such security should be sold. Today, when their market price are these, what are the number to be sold? So 1928.4 divided by 1000 give me 1.9284 is the number of share to be sold. Similarly, 3856 divided by 1500 give me 2.5712 the number of share to be sold, which is what the examiner has asked. So this question has also taught you one thing. When they ask you, the overall portfolio to be sold is fine, but exactly how many shares in each company to be sold, that should be in the original weightages, where like how it should be sold. Question number E. Sir, advise the position in Nifty futures and determine to be bought or sold. Sir, now you are in the alternative 2. I need to hedge a portfolio of 20,000 where beta is 1.4. So 20,000 multiplied by target beta of 0.95 minus present beta of 1.4 divided by price for future is 8250 multiplier is 210. I get 519 contract I need to short. That is what examiner was expecting in part number E. Part F. Calculate the new systematic risk if company has taken in Nifty futures. Sir, this position which you were talking about, company has taken this position. So now calculate beta again. Do you agree now ideally I should have a beta of 0.95? Because you wanted to adjust the beta, you took the futures position because you wanted the beta to happen as 9.95, right? You calculate that beta and justify whether it is 0.95 or not. But for that, there is a 2% rise in Nifty. When they talk about change, I said for beta calculation, you will have to apply change by change formula. For 2% rise in Nifty, right, people, how much is beta? Change by change formula I have to apply. So please look at the solution. It's really simple. I have two things in my portfolio. At 0 point, I have 20,000 of shares. And I also have futures whose value for the purpose of portfolio is considered 0. So overall 20,000 value of portfolio here. When Nifty rise by 2%, sir, I have short the futures. How many futures? 519. Overall, what is the gain loss? 519 futures short, where price every future is 8250, and I have short 200 and one contract has multiplier of 210. This entire thing multiplied by 2% give me 179 crore 83,350 lakhs. So 179 lakh 83,000 350 is the amount of loss I will have. So this is the loss I have incurred. That is not the part of my portfolio, the overall futures, but the loss become the part of the portfolio. That is a negative amount of cash outflow I have to show you. Sir, what about my portfolio? If market rise by 2, the existing portfolio which had a beta of 1.4 will rise by 2.8. So 2 multiplied by 1.4 is 2.8, which means the portfolio of 20,000 will become 20,560. So 20,560 is the portfolio value in which futures has a loss of negative 179, negative 179.83. 179.83. So overall value of the portfolio has become how much? Sir, 2560 and 179.83 give me 2380, 20,380 point something value of portfolio. So overall change in the portfolio after the effect of futures in percentage terms is how much? And let's divide that number with the change in market of 2%. So sir, 2560 minus 179.83 is 2380.17. It has changed by what percentage? Minus 20,000 divided by 20,000 is 1.90 percentage change as increase, right? As increase due to 2% increase in market giving me 0.95 times beta. That is what examiner wanted you to do. 1.9% change due to 2% change in market as 0.95 times beta. That is how we have solved people question number 26. Boss, what is the state of your comfort on this particular question, question number 26? Please, people in the class, tell me, are you all there with me? 26th gets done. The next concept we're gonna do is the concept related to margin on futures. After this topic, the entire discussion of future forward gets done. People in the class, let's talk about futures. Any particular doubt or thing that you want to understand or ask? All set? Futures, let's discuss super quick. Sir, we talk about margin. The concept is really easy. Whatever position I take in the future, I have to give some security deposit to the stock exchange, calling it to be margin. Suppose I take a position for ₹1,000 in the stock exchange future. I am long, you are short. Simple common sense. Initially, both of us gave the stock exchange 200 as the security deposit. Why? Because whatever gain loss, see, when I take long position, you take short position, both of us will have gain loss every day. So stock exchange will adjust those gain losses from the amount in the form of security deposit we have given to them, called as initial margin. So every day the amount of gain loss will be adjusted to the margin, and every day I will have a closing margin, daily closing margin I will have. Yes, sir. Suppose initially we gave 200 rupee. Next day the price become 1100. I am long. When 1,000 become 1100, it is my gain. You are short. When 1,000 become 1100, it is your loss. So stock exchange will deduct this loss from your account, transfer it to my account, because to me it is a gain. Your balance with the stock exchange right now is 100. My balance with the stock exchange is 300 because price has become 1100. Tomorrow if the price become 1080, 20 rupee I have loss as a long price has fallen. You have gain as a short price has fallen. So my balance become 280, your balance become 120. This way the gain losses of every day, is adjusted every day to the initial margin. This process is called as mark to market. Right now, sir, suppose on a day I had 80 rupee gain, you had 80 rupee loss, so your balance became 40. Now the stock exchange is worried that 200 rupee deposit I had taken, of which 160 seems utilized and now only 40 is left. What if the loss is 50? What if the next day loss is 50? So they have decided a maintenance margin. They say that this particular level of margin everyone needs to maintain, below which if your margin goes below which if your margin goes, you will have to pay more amount how you pay initially. You paid initially 200, so if you go below 50, you have to pay more amount such that your margin balance become equal to the initial margin of 200. So sir, if it is 40, you have to pay 160 more so that your closing can become 120. Terminologies: you have gone below maintenance. The amount that you pay is called as margin call. Such an amount you pay that the margin balance become equal to initial margin of 200. So my balance 360, your 200, and next day the same story continue till expiry. That simple is the calculation that you have to do. Sir, initial margin, amount that you give initially. Maintenance, you minimum need to maintain. Daily gain loss adjustment, mark to market. Margin call, and everything you have learned. Sir, last thing. If the initial margin is specifically not given, this statistics formula you have to use, which is mu, which is average change, plus 3 times into standard deviation of change. Examiner will give you the information, right? And maintenance margin is 75% of initial margin. Let's solve the LDR question. Question number 30. Sir, price Nifty future 9170. Index has 50 quantity requirement. 8% of the contract value is initial margin. Maintenance margin is 6%. Sir, how much is the contract value? 9170 is price per future where contract size is 50. So 485,500 is the total value of future, of which 8% is 36,680 I need to initially give, and 27,510 is 6% of that value which I need to maintain. Done? Fine. Sir, settlement prices of index, ideally they should give me index futures price. Why? Can I settle a futures position with the spot price? No, it's their mistake, and it's your ability to look at the minuteness that you are able to identify such mistakes. So index futures price should be given, not index price. So let's assume the given prices as index futures price for the respective day, and they are given as this. Mark to market and daily closing balance you need to find out. When 917093 become 9380 as a long position, what do you feel gain? 9380 minus 9170 is 210 on 50 quantity is become 10,500 gain. So 36,680, which is the balance of 0 day, at the end of first day it become 47,180 plus 36,680 on my calculator become 47,180. Format: day from 0 to 5, settlement price of every day, gain loss of every day if there is any margin call of that day, and closing balance of every day. So I am 47,180. Next day when the price become 9520, further gain, add the amount of gain of 7,000 to this price, you get the closing of 54,180. On a particular day the loss became 7, due to which the margin was going below the maintenance margin of 27,510. In that case, what do? You do a margin call such that the margin balance become equal to the original margin of 36,680, and that's where you will have margin call. Yes, the same activity which you have done for long, the same activity you will have to do for short. For short, the gains become losses. For example, you took a position at 9170 when it become 9380. As a short, when price increase, it is a loss for you. So initial margin of 36,680 will bear a loss of 10,500. Sir, the balance of 36,680 less than 10,500 become 26,180. Has it gone 26,180? Has it gone below maintenance margin? Yes. So you bring in the amount which makes it equal to 36,680, which means on the first day itself there is a margin call, you make it 36,680 again. That is how the margin adjustment happens. The question gets done, margin on futures. There's this small topic which we have not discussed. You will have to do it at your own, just one question. Yes, we are entirely done with futures and forward, entirely done, right? So boss, this completes the discussion on future forward. Now we'll take a 15-minute break. After we come back, we will at a single stretch complete the entire option. It is 12:15 right now. Let's meet back at 12:30. At a single stretch, we will complete the entire option and maybe if possible beyond that. Again the same pattern, learning the concept, applying those concepts to the questions. I'm trying my best to solve as many questions as I can, but within the given time frame. Yes. So thank you so much, everyone. Let's meet back again after 15 minutes at 12:30. Please continue to be there. Please be live. You will learn as much as possible. It'll be worth. Yes. Bye. Okay. Everyone, are you all there? Shall we begin? Are we all back? Come on, people. There are we all, please. Tell me. Shall we proceed? So, sir, we need to now discuss the next contract, which is option. If I have to take you to the basics, do you remember in the asset-based derivatives, we had forward, futures and options. Forward and futures we have discussed, we will now talk about options. So everyone, what this contract is? Option has two different contracts. One is call option, another is put option. Call option is an option to buy the underlying asset. So for example, at 0 point, when you enter into a contract today, right? When you enter into a contract, one party buy the option, another party sell the option. There are two parties. The difference as compared to forward, the difference here is that here it is not compulsory to buy. If it is call option, it's not compulsory for you to buy. You entered into a contract to buy the underlying asset, but you have a choice, you have a right, you have an option. There is no compulsion to buy at an underlying by the underlying asset. Sir, let me tell you more details about it. Just give me a second. Yes, fine. So, imagine call. The meaning of call is option to buy. So, imagine this piece of paper, imagine this contract which is option to buy the asset. If I sell this piece of paper to you, on this piece, on this option, on this contract, your position become long, right? My position become short. Sorry. Your position become long, my position become short. You have the piece of paper, you have the option. What option? Option to buy the underlying asset. So we decide the underlying asset, we decide the expiry at which buying selling will take place, we decide the quantity, say 10 grams of gold, and we also decide the price at which you have an option to buy at a price of 92,000 on the day of expiry. You can decide if you want to buy or not. Sir, similarly, if it is put option, similarly, this time this piece of paper, when I sell to you, what is this piece of paper this time? Option to sell the underlying asset at exercise price. Sir, option to sell gold at 92. This piece of paper is this time an option to sell. When I sell this piece of paper to you, your position become long, my position becomes short. But your position is long, you have bought it, you have the option, you have a choice to do what? To sell the underlying asset to me. This time you have a choice to sell the underlying asset to me. Previously you had a choice to buy the underlying asset from me, correct? So call or put, both of them will have both the position long and short. Long means the person who has the choice, short means the person who has given the other party the option. In both the contracts, there is the underlying asset expiry, contract size, and the exercise price. When a contract is entered today between the two parties, sir, we have to receive or pay a premium. Meaning to say, today, if I give you a choice, if I give you option, whether call or put, I give you a choice, your position is long, my position is short. So since you have got the option, you have to pay me a premium. So I will receive the premium. You will have to pay to me the premium, sir, which is also fine. The next is what about exercise? On the day of expiry, there would be some spot price in the market. Yes, sir. You compare this spot price with this exercise price to decide whether you want to exercise or not. For example, call is an option to buy at 90 to 10 grams of gold. Suppose in the market on the day of expiry, the spot price become 95. Will you buy the gold at 92 under the contract? Yes, you will exercise the option. And suppose the gold in the market turns out to be 90, then will you buy the gold at 92 under the contract? No, then because market has cheaper, the contract will get lapsed. Put as an option to sell. In the price market is 95. Will you sell? You have an option to sell at 92. Will you sell at 92 if the market price is 95? No, it will get lapsed. However, if the price is 90, you will exercise. So by comparing the exercise price with the spot price on the day of expiry, you can figure out whether I want to exercise the contract or lapse it. Yes, fine. Sir, now let's think about the gain loss, which means today you have entered into the contract. Today you have entered into a contract. On the day of expiry, if the net settlement happens, how much will be the gain loss? Yes, boss. So please listen to me. The calculation of gain loss is really simple. Sir, call option is an option to buy. Let's think about call. This is a similar table to that convergence where we have long position as well as short position, bullish scenario as well as bearish scenario. Every possibility related to options is covered in this table. Beyond this table, nothing can be there in the exam. So please listen to me. Sir, long call, which means you have an option to buy. At what price? At a price of 100. Price in the market has become 130 on the day of expiry. Logic, are you aligned? Contract was entered at 100. You have a choice to buy at 100. Price in the market is 130. Will you buy? Yes, you will exercise. How much gain do you feel for yourself? Something which is of 130 in the market, you can buy for 100. Can you feel a gross payoff of 30? Which means on the day of expiry, how much should the net settlement between the two parties? Between these two persons, the gross settlement of 30 should happen. You are long, I am short, I will pay you 30. Logic? Fine, sir. At 0 point, if you are long, you must have paid a premium to me. When you got this option, you must have paid a premium of to me of rupee 10. So 30 you receive on expiry. 10 you paid a premium at 0 point. Your overall net payoff or your overall profit is just 20 rupee. Correct? Fine, sir. Next. So since your profit is 20, my net loss is 20. You received 30, I paid 30. You paid me 10, I received 10. Overall, my loss is paying you 30 on expiry, receiving 10 at 0 point in form of premium. Net outflow is 20. Fine, sir. This also goes well. Next. Sir, if the price in the market turns out to be 60, you have an option to buy at 100. You have an option to buy at 100. Price in the market is 60. Will you buy at 100? No, option will lapse. Which means on the day of expiry, we will not meet, the gross payoff will be 0. But you had paid to me a premium at 0 point. So 10 rupees lost to you, 10 rupees profit to me. Sir, what if the put option it is? Option to sell the underlying asset at exercise price. Fine. Exercise price is 100. Price in the market is 130. You have an option to sell at 100. Will you sell? No. 0 gross payoff. But you paid to me a premium of 10. 10 rupees as a loss to you, gain to me. Fine. Sir, if price in the market is 60, you have an option to sell at 100. Will you sell? Do you feel a gain for yourself? Yes, 40 rupees is a gross payoff, gain to you, loss to me. But for that, you have paid 10 rupee premium. So net 30 is gain for you, 30 is loss to me. That is how you conclude overall all the possible position of call and put, on which even there are practical questions. Madhav, very great. You took your classes, cleared in first attempt, appreciable. When was your attempt, Madhav? So this is how, so Madhav, you would be able to then imagine these charts which you see on the screen right now. Correct? People, if you are all set, let me take you to the practical question. The first practical question of this type that you're going to do is question number 32. Basic question. September 25. Oh my God, things are really fresh in your mind. Come on. Fresh Bakery Limited, a share price has suddenly started moving upward and downward in the rumor that company is going to have collaboration agreement with MNC. There is this company, Fresh Bakery Limited. The share price of this company in the spot market, the prices started moving up, down, fine. Sir, if the rumors turns out to be true, stock price will go up. But if rumor false, stock price down. If rumors are correct, price go up. Rumors is false, price go down. Fine. Sir, to protect from this, investor purchased call and put option. Fine. What are you saying? A very good structured book, guys. It will be really helpful during the last revision. Was it really, Madhav? Genuinely, it was. So that's great. I feel happy when someone says that sir, books are helping me out, especially these structured notes. Ultimately, when a regular batch student revise it, or a faster, or any student revise it on the day of exam, it really makes his learning quicker and stronger, deeper, because he can now imagine things rather than reading it. True. Yes, sir. Bringing y'all back to this. Come on. So to protect from this, investor purchased the following call and put option. Boss, what is your position long? Because you purchased. One call you purchased, one put you purchased. Call is an option to buy the share of Fresh Bakery. Put is an option to sell the share of Fresh Bakery. Fine. 1 3-month call with a strike price of 52 at a premium of rupee 2 per share. Let's try to interpret. I purchased option to buy. One contract I purchased, which is call means option to buy the share of Fresh Bakery at a price of 52, for which I paid a premium of 2. Since my position is long, I have the option, which means I must have paid a premium of 2, right? What is the time period? After 3 months, all this should happen. Similarly, I purchased put, which means I have an option to sell at a price of 50. When I got this option where I can sell the share, to get the option I had to pay 1 rupee of premium, and that is after 3 months. The selling option to sell is there. Premium is paid today. Assuming 50 lot size, which means the contract size determine the following. Investor's position means profit loss. If the price in the market in 3 months turns out to be 53, which means if ST is 53, then what happens? Simply think long call and long put separately. Try to calculate net payoff and then ultimately add them up. For example, you have an option to buy at 52. Price in the market is 53. Will you exercise? Yes. How much is the gross payoff? 1. But you paid a premium of 2. So how much is the net payoff? -1. On a quantity of 50, it is -50. Next, you also have a put option to sell at 50. Price in the market is 53. Will you sell at 50? No, market already has a higher price, which means no gross payoff. But the premium which has gone is gone. So if 1 rupee of premium when I deduct, so total 50 rupee of premium gone. So overall loss 100 rupee, 50 on call, 50 on put. Am I able to explain it to you? Please tell me. Easy, basic, logical. Next. Sir, if the investors, what is the investor's position if the price crashes to 46? I have an option to buy at 52. Price in the market is 46. Will you buy? No. But the premium of rupee 2 gone, so overall 100 rupee loss on 50 shares. Fine. I have an option to buy, option to sell, put, option to sell at 50. Price in the market is 46. Will you sell? Yeah. How much is your gross payoff? 4. I can feel a gain for myself because I have an option to sell at 50. Price in the market is 46. But for that, I have paid a premium of 1. Net payoff is rupee 3. On 50 share, it is 150 rupee of gain. So 150 gain, 100 rupee loss, overall 50 rupee profit. That simple. The question which you can observe has been asked by the multiple times by the institute is there. That simple question is there on the basic net and gross payoff by the institute. Dhananjay, you were about to revise option only. Valuation is your weakest part. Dhananjay, valuation is really easy. I mean, literally very easy. If you can be here for the next few minutes, we can make it. The binomial, if you are talking about, we can make it simplified, the most simplified. So, call put basic things have been discussed. Just a summarization of certain things. Sir, if you are a long, you are also called as option holder. And as an option holder, you have a decision to exercise. Yes, sir. Obviously, if you exercise, you will receive the payoff. because you exercise only when it is a gain to you. On the expiry, if it is a gain to you, if you are receiving the gross payoff, then only you will exercise. Yes, and for that you have to pay a premium at 0 point, which is our outflow. And same from offshore short perspective. Someone who's short, when I have sold the option to you, I am also called as option writer. I will receive the premium, and if you exercise, I will have to pay to you a payoff. Yes, boss. Fine. Sorted. How do you calculate gross payoff? We have a common sense, not a formula. What is the net payoff? We have the common sense, not the formula. Be clear with what is inflow and outflow, and automatically the gross payoff and the net payoff will be 100% always correct. Fine. Great. Taking you ahead to the discussion, which is binomial model. But before that, we need to solve one more question. 32 we have done in the class. Next similar nature question is 37, which is not based any particular logic, common sense based question. We will talk about 37 in the class right now. Come on, everyone in the class, please, please, please. You as an investor had purchased 4-month call option on equity share of X Limited of rupee 10, which the current market price is 132. Oh my god, a single line and so many information. Everyone pay attention to this line again. Investor had purchased, position is long, 4-month call option, which means expiry is 4 month. Fine. Call option is option to buy the equity share of X Limited, which means underlying asset, face value 10, current market price 132. So this is the share of X Limited whose price in the market is 132 with face value of 10. I have an option to buy that share at a price of rupee 150 after 4 months. This option I have because I purchased. Fine. You expect the price to range between 120 to 190. So given probabilities and everything is there, expected share price at 4-month end. So if you have possible prices and the probability, price into probability give you expected share price of 168.5. Extremely easy. Part number A, extremely easy. Second, what is the value of call at the end of 4 months if exercise price prevails? It's important to interpret this. Solution is really easy if you are able to interpret it. What it says, that if exercise price in the market prevails, meaning to say on the day of expiry at the end of 4th month, the spot price in the market is equal to the exercise price. Sir, 150 is the exercise price. On the day of expiry, the price in the market is also 150. Then at the end of 4 months, how much premium, how much value you will be ready to pay for that option? Sir, you mean to say value is premium? Yeah, when you buy an option, what do you pay? What value do you pay? The premium you pay. So on the day of expiry, you see that there's an option expiring today, the price of which in the market is 150, and then it gives you an option to buy the share at 150. What is the benefit? You get zero benefit. So since you get zero benefit, the price that you are ready to pay for that option is also zero. Yes, fine sir, done, sorted. Next, in case the option is held to its maturity, what will be expected value of call option? Sir, if I hold the bond, hold the option till maturity, till the end of 4 months, where I have all these possible prices, what is the expected value of call option? They are not asking the value of call, the expected value of call. Why? Because when the prices are different, the value of call will be different. So the value multiplied by probability is the expected value of call option. For example, sir, the logic behind solving this question is really easy. It says, today when I buy an option, how much is the value that are ready to pay today? Sir, the premium that I'll be ready to pay today depends on the payoff I am going to get back on the day of expiry. On the day of expiry, if I'm receiving 10 rupee, then today I'm ready to pay 10 rupee, not more than that. Yes. However, in this case, they are asking us to calculate the value of option not today, on the day of maturity only. That on the day of maturity, what will be the value of option? Common sense. Price in the market is 120. I have an option to buy at 150. Will I exercise? No. Is it giving me any payoff in the future? No. 0 rupee. Price in the market is 140. I have an option to buy at 150. 0. Price in the market is 160. I have an option to buy at 150. How much is the payoff I'll receive? 10. Here 30, here 40. So these are the payoff I am going to receive on expiry. The probability of receiving these payoff is this. So how much is the expected payoff I'm going to receive on the day expiry? Payoff into probability give me 14 rupee of payoff I will receive on expiry. So how much price maximum is expected to be there of that option on the day of expiry? Rupee 14. Rupee 14. Sir, next, find out the price of share quoted at stock exchange to value the call as computed in C above. Everyone in the class, please listen to it. It says, price of the share quoted in a stock exchange to get the value of call computed in C above. In part C, you calculated 14 as the value of call. In your understanding, what should be the what should be the price of the share to get the value of call as 14? That particular number, what should is there? Sir, if the price is 164 of the share and I have an option to buy the share at 150, then exactly 14 will be the value of call. So 150 plus 14 will be 164 as the share price. Question 37th, people in the class, gets done. Question number 37, people in the class, gets done. Now I take you to the next concept before I can teach to you the next question. Come on. Concept of valuation means how do you find the value of an option, meaning to say how do you find the premium to be paid on an option for which there are two models, binomial and risk neutral. Right? Dhananjay, we cannot take a particular question in this revision session. Okay? 34th, in fact, is something you can ignore. Okay? Is not that important. So come on. Come on. Sir, binomial model and risk neutral model to find the value of an option. It's extremely easy if you understand the story really well. Sir, what it says? It says that at 0 month, listen to me carefully, at 0 month, you want to enter into an option contract, which will expire, let's say, after a year. So today, how much is the premium I should be ready to pay for that call option or for that put option is a simple thing we want to answer. Concept says, you have to first of all think of the price of the underlying asset. At 0 point, underlying asset will have a spot price. Yes, sir, it is rupee 100. On the day of expiry, according to the assumption of this model, there can be only two possible prices. One is above 100, another is below 100. It can be different. Above can be plus 20, below can be minus 30, it can be anything. But to this share price, there can be two possible prices. Suppose examiners say upside price is 120 and downside price is 80, which means ACU is 20 and SD is 80. Right? Fine. So there is a price today and there are two possible prices in the future. Then there must be also the probability of these prices moving up and down. Yes, how do we find that probability? Those probabilities are hidden. Listen to my line very carefully. These probabilities of price moving up and down is somewhere hidden, somewhere integrated or somewhere implied in the spot price of today. Sir, how do you know that? Let me show you. Let's assume the price of probability of price moving up is P and the probability of price moving down is 1 minus P. So what is the expected price after a year? 20 into P plus 80 into 1 minus P. Yes, sir. Expected price after a year is 120 into P and 80 into 1 minus P is the expected price. Fine. Sir, if I discount this amount and bring to 0, will I get the spot price of today? If I discount the future possible spot prices and bring it to 0, will I get the present spot price? Yes. Sir, let's discount it. Let's assume the rate of interest is 12%, simple interest, time period is 1 year. So the discounting factor is 1.12. Let me divide it by 1.12 so that I can get the price of today, which I already know is 100. So which is why we are saying that if the price we already know, the price that it formula calculates we already know, then can we back calculate the probabilities? of price moving up and down, which is already hidden in this 100. When you solve this entire equation, only one number is missing, and the probability turns out to be 0.8, and 1 minus p turns out to be 0.2. Means the probability of price going up is 80% and the probability price becoming 80 is 20%. Yes, sir, fine. So please, the way you are learning it is exactly the sequence of solving even the practical question, because if you realize what we are doing here is nothing but a practical question. Single period binomial tree, first you have to draw. First you have to draw the timeline of the contract. 0 point expiry. At 0 point there is a spot price S0, then there is SU and SD, and then you calculate probability. But before probability you have to do one more thing, which is calculating the discounting factor, the future value factor capital R, denoted by capital R. If the compounding is discrete, continuous is silent, your formula accordingly get decided: 1 plus r by k to the power nk e raised to rt, or 1 plus rn. In our case, the rate is 12%, time period is 1 year, so r become 1.12. But otherwise, r is the rate of interest per annum, t or n is the time period till expiry in terms of years, and k here is the compounding frequency. That simple, exactly similar as derivative is the thing. There is just one point of difference that I will explain to you later. This point of difference I will explain to you later. But for now, the future value factor, which is capital R calculation, is clear. After drawing binomial tree, calculate capital R. Use the same capital R in the formula to back calculate the probability. If the examiner asks you to calculate the probability using risk neutral model, make it use this formula. If the examiner asks you to calculate probability using binomial model, use this formula. Sir, this is a direct formula which gives you probability, which is nothing but derived from here only. Binomial model formula is derived from here only, from risk neutral only. It says capital R minus D divided by U minus D. Sir, what is capital R? Capital R, sir, we know is future value factor. Capital R is future value factor minus D. Sir, what is D? Please listen to the D carefully. Sir, how much is SD relative to S0? Sir, it is 0.8. And how much is SU as compared to S0? Sir, it is 1.2. So this is my D and this is my U for the purpose of formula. Capital R 1.12 minus D is 0.8 divided by 1.2 as my U minus D 0.8. When you solve this, you get the answer of probability directly, which will be same answer as this, which is 80 and 20%. Which means in the entire equation or the entire concept, the flow of solving is same. The only difference is the way we present the formula. Right? The only difference is calculating probability. So fine, sir, now I know it is 80% and 20%, and people, that is when the valuation will now finally happen. So far in our discussion, we have only talked about the spot prices, not options at all. Now for the first time, we will talk about call input. Suppose there is this call option whose exercise price is 110. Means option to buy the underlying asset at a price of 110, whose price on the day of expiry ST is 120. Basically SU is 120. Will you exercise? Yes, 10 rupee of payoff. CU represents call payoff of upside. CD represents call payoff of downside. PU put upside payoff. PD put downside payoff. So option to buy at 110, whose price in the market is 120, 10 rupee payoff. Option to buy at 110, whose price in the market is 80, 0 rupee payoff. Now you apply similar common. So same common sense used for valuation. You will receive. Listen to the flow, that will give you the clarity. You will receive 10 rupee, has 80% chance, and you will receive 0 rupee, has 20% chance. So how much gross payoff are you expected to receive? 10 multiplied by 80% and 0 multiplied by 2%, and all that you will receive at the end of first year. So how much is the price you are ready to pay? for that option today, which is going to give you this much expected payoff? Sir, present value of what I am going to receive is how much I can pay today. So this is the amount you are going to receive. Present value of that is divided by capital R, which is 1.12. When you solve it, you get the amount of premium that you are ready to pay today is the value of option. It is, can I say, the most simple concept of options if you are able to connect. Please, please, please. Really a simple concept of options if you have to understand. Sir, what next? What next? Imagine if it is put. What does put say? Put says, if the price in the market is 120, I have an option to sell at 110. Will I sell? No, zero payoff. Price in the market is 80. I have an option to sell at 110, which means 30 rupee of payoff. Will I sell? Yes, 30 rupee of payoff. Now same common sense. You will receive 0 rupee has 80% probability and 30 rupee you will receive has 20% probability. How much are you expected to receive? The present value of that you are ready to pay in the form of value for that option. You are ready to pay in the form of premium for that option. So you will say 0 into 80%, 30 into 20% divided by 1.12 is 5.36 as the value of put. This is learning till a particular point where you can calculate the value of an option. Sir, let me take you to a particular question, solve that particular question and further take you ahead in the concepts, right? So I think question number 38 is what we can afford to do, right? So let's proceed. The following information is available regarding a share. Sir, the current market price of the share is 420. Strike price, which means option to buy or option to sell, depending upon whether it's call and put, is 450. Maximum price in 3-month time 525. Minimum price is 378. Continuously compounded rate of return 8%. E raised to RT. The value is given as 1.0202. Fine, sir. Calculate the value of 3-month call option by using binomial model and risk neutral model. This particular part we will think about later. First, let's try to value using risk neutral model a call option with 3-month expiry. So first thing is to draw a decision tree. 200, 525 and 378. You look at this option. 420, 525, 378. Fine, sir. This is my timeline. 0 month, 3 month. Here I want to find out the value of premium. But before that, I need to find out the probability of price going up and down. 525 has P probability and 370 has 1 minus P probability. All that is the price will be after 3 months. What is the price of it today? So before calculating probability, I'll calculate capital R with e raised to RT because continuous compounding examiner has given. R is 0.08 per annum, T is 3 by 12, so e raised to 0.02 is 1.0202 as my capital R, which is used here. Using this equation, let's try to find out the probability. So 420 into 1.0202 when you do, in the right hand side you have this and this, correct? So wait, 420 into 1.0202 minus 378 m plus and 525 minus 378 divide equals to into memory recollect is 0.3434. Probability is 0.343428 something. So probability of price going up is 3434. Probability of price going down is 65.66. Even the probabilities are clear. After drawing decision tree, after finding capital R, after finding probability, now I can proceed to find out the value of call. Option to buy at an exercise price of 450 where the price in the market is 525 give me 75 payoff. Option to buy at 450 where the price in the market is 378 give me 0 payoff. So I'll receive 75 has 34% probability, I'll receive 0 has 65% probability. How much am I expected to receive? And present value of that amount is the price that I'm ready to pay today. So 75 multiplied by 0.3434 whole divided by 1.0202 is 25.245, which is 25.25 the value of call. Using risk neutral model, could you all realize how simply could we all arrive at the value of call option, the same steps in the out notes you had to follow? Everyone in the class requesting your responses. Are you all there? Please come on, tell me. I will take you ahead in the concepts again. In the concepts again, I'll take you ahead to teach you one more method of doing this valuation. What is that method? Let me explain. Sir, what is that method? Let me explain. Sir, you remember the original story? 100 price can become 120, 80. These are the call payoff, put payoff. Fine. Sir, let's now find the delta of an option. Delta of an option means what? Delta means change in the call payoff. Change in the call payoff due to change in the price of the underlying asset. When price of the underlying asset changes from 120 to 80, the payoff changes from 10 to 0. From 10 to 0, the payoff become when the price change from 120 to 80. When you do calculate it, the delta, people in the class, turns out to be what? The delta turns out to be 0.25 times. Correct? Sorted. Sir, similarly, put also has a delta. Payoff change from 0 to 30 when the price change from 120 to 80. It is delta of 0.75 times. Fine. Sir, what is the use of this delta? Using this delta, we can do delta hedging. Sir, what hedging now again? Array boss, at 0 point the share price is 100. It is subject to fluctuation in future. It has uncertainty. So along with this spot market position, if I take some position in option, so I can do hedging, because position taken in derivative with an intent to avoid uncertainty of the spot market, we call as hedging. So with the option, I can create a portfolio which is uncertainty free, a portfolio which is risk free. I can create. Sir, how can you create? Using golden rule. How do you hedge? You hedge using golden rule. Sir, suppose you have a long position in the spot market. Now you all try to think and answer my question. You have a long position in the spot market. Fine, sir. You want to hedge it. So if you have a share today, suppose, then do you agree at some point on a later date you will sell it? So golden rule says do in derivative today what you will do in a spot market on a later date. Today, when you have share on a later date, you will sell it. So why don't you sell it today in the derivative only? Now apply your common sense and tell me, you want to sell a share. On that share, there is a call option, there is a put option. What should you buy? Or let's think about put option. To the put option, what should you do? Buy the put to sell the underlying asset, or sell the put to sell the underlying asset? Common sense. Sir, put is an option to sell. Put is an option to sell the underlying asset. When I buy the put option, I will get an option to sell the underlying asset. So if I want to sell the underlying asset, I should buy put. So to hedge the long position of the spot market, you should buy a put option. Can you please, the way we have presented as long, we have done multiple times, is plus sign. Short, we have learned multiple times now, is a negative sign. In our case, both are long. So sir, when I want to start hedging, I already have a spot market long position. To hedge it, you can also long a put option, right? Sir, similarly, if you have call, I have a spot market long position. As per golden rule, I want to sell it in the derivative market. Call, which is an option to buy the underlying asset. If I buy call, I will get the option to sell. Sorry, if I buy call, will I be able to sell the underlying asset? Or if I sell call, then I'll be able to sell the underlying asset, that you think? Because as per golden rule, I want to sell the underlying asset in the derivative market. Sir, buying a call is option to buy the asset. If you want to sell the asset, then you need to take a short position, which means giving the other party an option to buy the asset, because when the other party buy it, you will be able to sell it, which means using call you will have to take a short position. Such simple is golden rule. To the spot market, you either long put or short call will give you a hedged portfolio. But sir, question, one call that you short will be able to hedge the entire share? No, only the delta times a share it will be able to hedge. One call will be able to hedge only 0.25 times share. One call that you short will be able to hedge only 0.25 share that you long. So the two things collectively become a risk-free portfolio, become a hedged portfolio. Similarly, one put that you long is able to hedge 0.75 share that you buy. The two things collectively become a risk-free portfolio. Sir, can you tell us or show us if it is actually a risk-free portfolio? Yes, I can. Let us go. Let us go to the presentation. Sir, what you have to do today is this. On the day of expiry, settle your portfolio and check what is the gain loss. For example, today, this table, do you remember that arbitrage table? Using the same table, we have to do hedging because that table has nothing to do with the arbitrage. This table is simply the table of inflows and outflows. Do you agree? Sir, 0.25 share when you buy. Come on, everyone. 0.25 share when you buy. What happens? What happens? Sir, today observe the timeline at 0 point, share price is 100. When you buy at 0 point, that particular share of 0.25 quantity, 25 rupees, the outflow from your pocket. Fine, sir. One call option you sell. One call option you sell. Sir, when we sell call, we receive premium. How much is the amount of premium we calculated as per binomial? 7.14. Overall, how much is the gain loss? 25 we receive minus 7.14 we pay. 25 minus 7.14 is 17.86 is the net amount blocked in the portfolio of two things in this hedged portfolio. Now let us see, everyone in the class, what happens on the expiry date. Yes, so please pay attention to it. On the day of expiry, after a year, the spot price can become 120 or 80. Agreed, sir. As per binomial, there can be only two possible prices. Next, if I have 0.25 share which I bought, let me go to the market to sell them. If the price 120, 0.25 share give me 30 rupee. If the price is 80, 0.25 share give me 20 rupee. Fine, sir. Sir, one call option that you had taken a short position, which means you had given the other party an option. Short is given the option to the other party. What was the option? To buy the underlying asset because it was call. Short means giving the option. What options? It is call, which means buy the underlying asset at 110 exercise price. Sir, the same call option we are talking about. Now tell me, if the price in the market is 120, will the other party exercise the option and buy the share at 110? Answer is yes. He receive a gross payoff of 10. You have to pay a gross payoff of 10. From your pocket, it is an outflow of 10. Right? Call, when you sell, it is an outflow of 10. Net, you are left with 20 rupees from the portfolio. And here, where you have given the option to the other party to buy the share at 110, if the price in the market is 80, then 0 rupee is the payoff because he will not exercise the option, and ultimately 20 is the overall portfolio inflows. Do you agree? Whether the price in the market become 120 or 80, the overall receipt that you have is 20 only, and you invested 17.86. First of all, can you feel, irrespective of the price, your inflow continue to remain same, your inflow continue to remain certain. There is no uncertainty regarding the inflow. First thing. Second, if you observe how much is the rate of return you have earned, 17.86 plus 12%, when you do it become 20, meaning to say this portfolio which became a risk-free portfolio in which you invested 17.86, the return this portfolio gave to you is a risk-free rate of return. With a 12% rate of return for 1 year, the value of the portfolio became 20. Yes. Sir, what are you trying to teach us? I am trying to justify using delta, using delta, you create a risk-free portfolio. That risk-free portfolio, when you take a position in, give you the final inflow, which is same irrespective of the price and which has the return as your risk-free rate given in the question. How do we have to do the entire thing? That I'm going to teach you now. Please listen to me. How do you have to do the entire thing? Listen to me. Sir, examiner, I'm trying to teach you an alternative method of finding the value of an option. What is the alternative method of finding the value of an option? Please listen to me very carefully. Sir, what happens? At 0 point, at 0 point, when you know that there can be two possible prices, you calculate delta, right? And using the delta, you create a risk-free portfolio, right? Today, when you create a risk-free portfolio, you know that you have to buy 0.25 share whose price you know. You have to sell one call option whose premium suppose you don't know, because that is what you have to calculate. Listen to me, I'm trying to teach you right from the scratch and another method of valuing the option. 0.25 share when you buy, 0.25 share when you buy, right? It is 25 rupee outflow. One option when you sell, it is the inflow equal to the premium amount which we don't know. Fine, sir, done. But you know that when the price become 120 and 80, the sell when you sell the share, it will give you 30 and 20. And the call option, when is net settled, the gross payoff you have to pay is 10 and 0. The price at which, the premium at which you have sold, you don't know. But you know that if the exercise price is 110 and the price in the market become 120, then you have to pay a gross premium of 10 because your position is short. Fine. Here it is 0. Overall, you will receive 20. And you also know that the amount of investment in the portfolio, let's assume this X. So amount of investment in the portfolio is 25 minus X. When you invest 25 minus X, a 12% on that return, 12% return on that portfolio is equal to 20 rupee. Do you agree to it? You know, whatever is the amount of investment, when you earn a risk-free rate of 12% for 1 year on that portfolio, it should give you 20 rupee of return. In this entire equation, if you observe, there is only one number, which is X, which is missing, which you can back calculate using this equation. This is another way of calculating the premium amount using delta hedged portfolio, because delta hedged portfolio has a final amount of inflow, a certain amount of inflow, and the outflow is also, you know, as 25 minus X, and the relationship between inflow outflow is the risk-free rate for whatever is the time period. Using this logic, let us solve a practical question and then you will be able to better understand what goes on. Yes. So the same question, 38. Now I will solve using this particular method under the binomial method. Sir, which method is to be used when? That I will separately guide you, that I will specifically guide you. But for now, let me particularly explain this method which you have learned. Okay, just give me a minute, just give me a minute. Yes, everyone. Cool. So, what were we saying? So, please be back. I need to apply this another method of delta hedging. Did you observe one thing? In the another method, you don't need the probability at all. Sir, what are you saying? Yes, let me prove that to you. Sir, using another method, first of all, you need to find the delta. So let's create a decision tree again. And this time without any need of probability. For example, price right now is 420, which can become 525 or 378. So SU and SD can become 525 and 378. Fine. If the price become 525, how much will the payoff of call? If the exercise price is 450, let's think. Price in the market is 525. I have an option to buy the underlying asset at 450, right? So payoff is 75. Here the payoff is 0. How much is the change in payoff due to the change in share price? So 78 minus 0 is 78, and obviously, sorry, 525 minus 378 is 147. So 78 divided by 147 is 0.5306. 1 second. 525 minus 378 divide equal to into 75. 0.5102 is the delta of call, right? If someone asks you what is the risk-free portfolio you should create today, so it is like for every one call option of exercise price 450 that you short, for every one call option that you short of exercise price 450, you should buy 0.5102 share of the company, 0.5102 share of the underlying asset. Sir, when you do it, the portfolio is a risk-free portfolio. It will give you a risk-free rate of return of 8% per annum. Sir, can we check it? So come on, let us proceed. Let's now create that delta hedging table. I asked you to buy 0.5102 share. I asked you to sell one call option at exercise price 450. Buy and sell. Price of every share in the market is 420. So how much is 0.5102 share? 420 into 0.5102 gives me 214.28 as the amount paid today. When you sell one call option, sir, you will receive the amount of premium which is X, which is not known today. Fine, great. So the net amount blocked in the portfolio is 214.28 to buy the share minus X, the amount of premium received. This is the net amount blocked. On the day of expiry, what happens? If the price become 525 and 378, when I go to the market to sell 0.5102 share, what is the amount I receive? Sir, 525 into 0.5102 is 267.86, and 378 into 0.5102 is equal to 192.86. These are the two amounts I will receive in the spot market when I go to sell the share. Sir, in the derivative market at an exercise price of 450, you had sold a call. Sold means given the option. Call means option to buy. So you had given an option to buy the underlying asset at a price of 450. If the price in the market is 525, will the other party buy at 450? Yes. The payoff you will have to pay to him is 75. If the price in the market is 378, he will not buy at 450, the payoff 0. So overall, from the portfolio, how much will I generate? Sir, 267.86 I will generate, minus 75 I will pay. So 192.86 is the amount finally I will generate from the portfolio, irrespective whatever be the price. Could I again justify to you that how is this portfolio a hedged portfolio, a risk-free portfolio? Because irrespective of uncertainty in the share price, my portfolio final value has a certainty. It is 192.86. Cool. Now I know the amount I invest and the amount which gets redeemed has a relationship of 8% for 3 months. 8% interest for 3 months using continuous compounding. So can I say the present value of this is equal to this? Or maybe the future value of this is equal to this? You can think whatever way you want to think. I am saying the investment today is the present value of this. Investment today is 214.28 minus X. Present value is 192.86 divided by e raised to rt, same continuous compounding you will have to use. When you solve this equation, you get the value of option as 25.24, the value of call, which is same value that you used using risk neutral model, that probability based model where we made use of probability. Here in this question, everyone in the class, if you realize, probability had no use at all. So it is the same in the outnotes, you have learnt it. You start with delta hedging. You start with delta hedging. You create a portfolio. Ultimately in this table, you just don't know one number and rest of it you know, and you proceed to solve the entire question. Boss, how much out of 10 are you people please clear with the entire story that we have done in question number 38? Please tell me. Last thing I have to explain is something related to why is when is which method used. Are you all? Every live and recorded people 10 out of 10 set. Come on, tell me. Every live and recorded. Yes. So now listen to my next thing very carefully. Now listen to my next thing very carefully. So, what I'm saying? We have subtracted the amount bought, but here it is positive. I mean, it's your choice. Dhananjay, choice is yours. Wait. Let me answer your question. Dhananjay, you can show it whatever way you want to show. Only the concept should be clear that amount I pay today is the present value of what I receive. Maybe it is your payment, which is why you show it as a negative value. Maybe it is your payment, which is why you show it as a negative value, which is why we learned it that way. Even if you show negative, there is no problem, but you have to understand the core that ultimately, right? How should I tell you? The receipt and present value of payment and the present value of receipt, if they are equal, then only I make an investment, and mathematically you have to solve it positive. Mathematically to solve, you have to take it positive. Are you please understanding? Yes. So great. Now explaining to you the last thing, the biggest confusion which happened in one of the attempts. Listen to it. In the attempt of November 23, what happened? Institute asked a question on binomial model and risk neutral model in the same question. If you observe the past exam papers, the study material, RTP, MTPs, you will observe that when institute ask risk neutral, student do this, institute do this. When institute ask binomial, student do this, institute also does this, right? But in this attempt, institute asked both in a single question. Now, obviously, it was clear that if you solve the same question twice, where all the steps are same except for this particular step, all the steps of risk neutral and binomial are same, then you won't get the marks. How has this query been resolved? Listen to me carefully. When institute asks you risk neutral, you do this. When institute asks you binomial, you do this. In a single question, either it will ask this or this, you do this or this. If institute does not ask you whether risk neutral or binomial, you do binomial last. In a single question, in a same question, if institute asks you both, what will you do? Risk neutral, you do this. But for binomial, you do this reverse calculation in the table. That is what you will have to do, and that is what we have done in question number 38, because in a single question it asks you both. So risk neutral do probability approach, binomial do reverse calculation from the table approach. 38th question with my best discussion people in the class gets done. 39th, you don't have to do. I mean, the next question we gonna do in the class is 42nd question. which we'll be able to do only after we have learnt the concept of two-period binomial tree. Everyone, please super fast pay attention to this. Super fast pay attention to this. Two-period binomial tree. Sir, what this is? During the expiry of the contract, if the change in price happens twice, for example, the expiry is 2 year, the price at the end can be 120 and 80, and after a year it can be 144 and 96, then it is called as two-period binomial model. The logic to do the two-period binomial model is same, except that when you do the present, you have to do the present value in parts. Like, sir, imagine the tree, 100 rupee S0, SU 120 SD80, SUU is 144, SUD 96, SDU 96, SDD 64. Binomial tree is there. Now, in case of binomial tree, the delta hedging, the reverse calculation concept doesn't apply. You have to do a simple risk neutral based approach, which is this approach, simple risk neutral based probability driven approach. Done. Reverse calculation does not apply. Sir, first step is you draw the tree. Done, sir. Next step is you find out the capital R. Sir, for the purpose of discounting, as I said, at once you will discount only for one particular period, not for both the periods in one go. So your capital R, even if the contract period is 2 years, the capital R will be only for a 1 year period. Sir, 1 year future value factor is 1.12. Fine, sir. Cool. Then you calculate the probability. So we have taken the same information 120, 80, 100, and the rate is also same. So the probability also remain 80-20. The next is calculating payoff. Imagine that it is put. Put means option to sell the underlying asset at a price of 110. Price in the market is 144. Will you sell at 110? No. Is price in the market is 96? Will you exercise? Yes, 14 payoff. Yes, 14 payoff. Yes, 46 payoff. Now, these will be the payoff has this probability, and these will be the payoff has this probability. So you have the value of payoff at respective point, and then you further discount it. How exactly? Let me show you. At the end of second year, either you will receive 0 or 14, the probability of which is 80 and 20. So how much are you expected to receive at the end of second year? Sir, 14 into 0.2 divided by 1.12 gives me, I am expect the present value at the end of first year of the payoff that I'm going to receive at the end of second year is 2.5. Fine. Similarly, payoff I'm going to receive in the second year, the present value of that today in the second case is 14 into 0.8 m plus and 46 into 0.2 m plus. Memory recollect divided by 1.12 is 18.214, which is 18.21. If the price become 80, then the price become 96 and 64, and in that case the payoff that I receive, the present value of that is 18.21. In conclusion, if the price become 80 at the end of first year, the payoff is 18.21 in present value terms at the end of first year. If the price in the first year become 120, then in present value terms the payoff you receive in the first year is 2.5. What are the probabilities of price becoming 120 and 80? Price will become 120 has 80% chance and 80 will has 20% chance. It means receiving the payoff of 2.5 in present value terms has 80% chance and 18.21 has 20% chance. So what is the present value of those expected payoff at 0 point? So what do we say? 2.5 is the payoff has 80% chance and 18.21 is the payoff has 20% chance. All that I am going to receive at the end of first year, what is the value of that at 0 divided by 1.12 is 5.04. Meaning to say what we have to mainly do, everyone in the class, please listen to it carefully. First discount this, bring here. Then you discount this, bring here. After that you discount them, and bring them to 0 point, which is what you do. You bring them back everything in parts. That's how the two-period binomial model tree works. Boss. Are you all able to connect yourself to what is going on? Please tell me. Are you all able to connect yourself? Please. Waiting for your responses. Come on, everyone in the class, please. Yes, boss. So now let me take you all to the next thing. Come on. Sir, this was a European option. Sir, what is this? You never explained what is European and what is American. Let me now explain. Boss, come back to basics. At 0 point, you enter into a contract to buy or sell the underlying asset on a future date. But exactly at which point can you buy or sell? On the day of expiry? Yes, if it is European option. European option gives you an option to buy or sell the underlying asset on expiry. American option gives you an option to buy or sell the underlying asset anytime till expiry. Which means if you want to exercise your contract here, you can here, you can here, you can here, you can. Are you understanding? So two-period binomial model that you have learned right now considers exercising only on expiry, calculating payoff only on expiry, not any time before expiry. That was American. Now you need to learn a modification of it. Sorry, that was European. Now you need to learn modification of it as American, which for us is again extremely easy. Yes. So now let's learn what exactly it is. People starting with it. Again, the thought process is same. Valuing the option at this node, then at this node, then at this node. At this node, what is the value? Sir, today, if the price in the market become 120, I will receive 0 payoff or I will receive 14 payoff. And the present value of those expected payoff is 2.5. But do you people agree it's an American option? If you want, you can exercise also. It's not compulsory for you to go till expiry. If you want, you can exercise today only. What will you choose? The one which is more beneficial. If you wait, you will receive 0 or 14. The present value of those future payoff is 2.5. However, will you exercise option to buy at option to sell at 110, market price is 120? I will not exercise 0. So it's better to wait. If I exercise today, I will get 0. But if I wait in present value terms, I will get 2.5. So higher of the two is what you choose. We will say maximum of, if I exercise today, what is the value? 0. But what is the discounted value of future payoffs? Sir, 2.5. So I choose 2.5. Next, at this node. Sir, at this point, at the end of first year, if the price become 80, then the next year it become 96 and 64, which give me a payoff of 14 and 46. At this point, when I spend, if I wait for the next year, I will receive these payoff, and the present value of the expected payoff is 18.21. However, at this point, if I want, I can exercise. I have an American option to buy at 110. Sorry, option to sell at 110. Even if the price in the market is 80, will I exercise? If I exercise, I will get 30 payoff. What will you choose? Exercising immediately will get you 30. Waiting for a year in present value terms will get you 18.21. I will choose to exercise immediately if the price turns out to be 80. Correct? Higher of the two, please observe, is 30. This is the same part at European, 18.21, the same part. But if you exercise, this is 30. So 30 is higher of the two is what you choose. In American, you don't have a choice to choose 30. Because you have to compulsorily go till the exercise expiry date, and the payoff is compulsorily 18.21 at the end of first year in present value terms. Here you have a choice to exercise. So please observe, at 0 point, when I spend, at the end of price, If it is 120, in present value term, payoff is 12, 2.5. But if the end of first year, if the price is 80, then the payoff is not 18.21, the payoff is 30 because I will exercise the option, yes. So what is the value at this point? I will receive 2.5 has 80% chance and I will receive 30 has 20% chance. So 2.5 80% chance, 30 has 20% chance, and the present value of it is something today. But do you agree? I can exercise it today also. I can exercise an American option today also. Option to sell at 110 whose price is 100. So 10 rupee. 10 rupee of payoff I can receive today only. So higher of the two is 10 versus this present value higher is 10, which is the value of an American option in case of put. Boss. Could I explain? At every node you have two choice. Wait for the next year. Take the future payoff, do the present value. Option 2, exercise immediately and higher of the two you choose. That was the main concept over and above European that American has. Boss, speak up. If you agree to it, I'll immediately take you to a practical question which gives you application, a precise application of what you have learned. So taking you all to the practical question. Come on. Question 42 on American option. We're gonna solve in the class right now. Come on, people. Please. Yes, sir. So let us go ahead. Question number 42, what it says. A 2-year tree for a share of ABC Limited at 0 point now, share price is 100, which can go 108 or 95 in a year's time, which after 2 years can become this and this. Consider a 2-year. Yes, sir, we can see it is 2-year. American, which means exercise anytime. Call option, which means option to buy the underlying asset, which is the stock of ABC Limited, at a price of exercise price of 98. Current share price 100, we can see risk-free rate 5%, continuous compounding, which means e raised to RT. Please observe e raised to 0.05. But time period is not 2 years. Because in one go, we discount only for 1 year. So T is 12 by 12 only, which means e raised to 0.05 is what we need. Fine, sir. Assume 2 period of 1 year each using binomial probability of price moving up and down. R minus D divided by U minus D. This is my capital R. What is D? 95 divided by 100, which is 0.95. U is 1.08 divided by 100. 108 divided by 100 is 1.08. The probability of price going up and down. Sir, R minus D divided by U minus D give me 77.9%. So 1 minus P is 22.1%. First part gets done. Expected payoff at node N1, N2 and N3. First we calculate for N2. Sir, think about the payoff. Option to buy at 98. Price in the market is 116.64, which means payoff from call CUU is 18.64. CUD is 102 minus 98, which is 4.6. Similarly, 4.6 and 0. If the price become 108, I have an option to, if I wait for 1 more year, I will get 18.64 has 77.9 probability, or I will receive 4.6 has 22.1 probability. Whatever I receive, the present value of that is how much? Let us calculate. 18.64 into 77.9% M plus 4.6 multiplied by 22.2% M plus, memory recollect is 15.53 divided by 1.05127. 1.05127 is 14.78 is the present value of what I will receive. But sir, I have a choice if I want to exercise today. Price in the market is 108. I have an option to buy at 98. If I exercise, I'll receive 10. However, if I wait for 1 more year, in present value terms, I'll receive 14.78. So it's better to wait. Higher of the two is exercise value is 10. which is also called as intrinsic value. The discounted value is 14.78, higher of the two is 14.78. Done. Sir, if the price become 95, what I will receive in future, the present value of it is 3.41. However, if I exercise today, I will get 0, so it's better to get and earn 3.41. If the value here I get 14.78, here I get 3.41, as I can see, sir, present value of expected payoff, or if I exercise today, the payoff is 2. If I exercise today only, the payoff is 2 rupee. Price in the market is 100, I receive 98. Sir, 14.78 into 77%, 3.41 into 22.1% divided by the factor to bring the present value of expected payoff as 11.67. However, if I exercise today, I'll get 2. So better don't exercise today, wait for a year, wait for further year. The present value of all those payoffs is 11.67, which is the value at node 1, which is the answer to this question. Boss, 2-period binomial model, please tell me, could I literally simplify for you guys, waiting for your responses? Could I, people in the class, literally simplify for you? What do you all say? Come on, come on, come on, come on, come on. Yes. So in conclusion, if you understand 1-period binomial model really well, 2-period is an extension, just that you do the things in part. That's all you do. An American, at every node you also choose whether I exercise today and earn the exercise value, receive the exercise value, or wait for a year, receive those payoffs and do the present value of it. Cool. So that was all from my side on binomial model. The next thing I'm going to teach you is regarding the Black-Scholes model, right? On which we won't do a very comprehensive question, but a question on a lighter note, one particular part of any given question. Let me, before that, show you the formula of Black-Scholes, people in the class. Complicated formula, more than the formula, it's about the application. More than the derivation, it's about the application, right? Formula you'll have to mug up as it is. Our learning is how do you apply the things given in the question to this formula. Sir, first you have to find out D1, which tells you log natural of spot divided by exercise price, rate, the risk-free rate, plus standard deviation of the underlying assets return divided by 2. So standard deviation square divided by 2 multiplied by time till expiry divided by under root of time into standard deviation gives you D1. And D1 minus the denominator give you D2. D1, D2 are Z values for which you can calculate the area or the probability, calling them ND1 and ND2. So spot price into the area of D1 and present value of exercise price into the area of D2. Minus, when you deduct, you get the value of call. And value of put is simply based on call-put parity theorem. Call-put parity theorem tells you present value of exercise price and value of call is equal to the present spot price and the value of put. So if I have call, if I have exercise price present value, if I have the spot price, can I have the value of put through this equation? The answer is yes. So for Black-Scholes, you remember the equation for call. For put, you apply call-put parity theorem. This simple is the thing. Now, point that you need to remember in this particularly. First, sir, spot price always has to be an ex-dividend price, which means if examiner give you spot price and the details of dividend being included in the spot price, you have to eliminate or remove the dividend, in fact remove the present value of future dividend from the spot price. In the future you are going to receive the dividend, do the present value of it and remove it from the spot price and calculate ex dividend spot price. First. Second, sir, ND1 and ND2 are the areas for D1 and D2 that you calculate. Suppose D1, which is the Z value you calculate, is here. So the area that you always need is till the left tail. If the D1 or D2 is positive, who are towards the right hand side. So the entire area till the left tail you need. However, if the d1 d2 is negative, if you have negative z, we are already at the left hand side. The area that we need is the area till left tail. That is all we need to primarily wanted to understand, based on which let's apply this thing and solve a practical question, question number 46 people in the class. Come on, come on, come on. So I am planning to keep this particular video only for derivatives, because it will help students to separately watch IRRM, those who want to watch IRRM actually. What do you think? It will separately help students, those who want to watch IRRM, it will help them to particularly watch IRRM. Yes. So now let's solve question number 46. The share of TIC Limited are currently priced at 415. So underlying asset I have, right? 415 is the spot price. Call option exercisable in 3 months. I need to find the value of call. Assuming it's a Black-Scholes question. Sir, call option is there. 3 months is the time till expiry. Exercise rate is 400. Risk-free rate 5%. Standard deviation of the share price is 22%. Based on the assumption there is no dividend. Is option worth buying at 25? Is the value of the option 25? Is the premium of the option 25 justified? Sir, the question is of valuing the option. Which means in total, sir, we've got 3 methods of valuation: risk neutral, binomial, Black-Scholes. Correct. We've got the 3 methods of doing valuation. Yes, sir, Black-Scholes, the formula. Sir, I need to first find out D1, which is log natural of spot buys by exercise price, R into variance by 2 into T, sigma into under root of T. Log natural of 415 divided by 400. Log natural of 415 divided by 400. Have we given the value? 415 divided by 400 is 1.0375. We have been given the value directly. So 0.03681 plus rate of interest being 0.05, standard deviation being 22, which is why I'll have to do this square, divided by 2 into time period as 3 by 12. 22 into under root of 3 by 12 is the thing. When you solve this, you get this. When you solve this, you get this, right? And the final answer of D1 is 0.5033. Please everyone in the class do solve it. 0.5033 waiting. सुपर फास्ट सॉल्व करो, क्योंकि कैसा है ना, ये तो करने से ही कॉन्फिडेंस आएगा, समझने का तो कुछ है ही नहीं ना। जहां समझना था वहां समझ के कॉन्फिडेंस आ गया, जिसमें समझने का कुछ नहीं है, करना ही है, करके कॉन्फिडेंस आएगा। करो। आई एम रियली सॉरी आई स्टार्टेड टू स्पीक इन हिंदी। I am really sorry. I didn't realize I started to speak in Hindi because that's my natural language. So I was saying, that was really funny. Thank God I realized it now. Imagine realizing it later. So sorry, I wanted to say, in the other concepts that we had learned, things were there to understand, right? But in this particular concept, there's nothing to understand. It's just applying or implementing or executing a particular formula. So you will get the confidence in this only when you do solve it. There's nothing to understand is what I'm saying. Binomial had things to understand. Calculation was not there. Here, it's mainly to solve, not understand. So do solve it, is what I'm saying. How smart is the brain? I never realized how was that switch. I mean, I was continuously speaking. How did that happen? I never realized. Which means you can now imagine. I've been taking batches in both the language for CA and CFA both, right? Primarily it is Hindi. Then for CFA it is always English. But it does happen that in my normal life I end up speaking Hindi with the people I am surrounded with. So when I have to speak English, although I'm always comfortable, but there is to my brain I know the natural language is Hindi. So that comfort immediately came to my brain. I started speaking Hindi. Yes. Bringing you back, people, solved it. So I have D1. Do I have the area for 0.5033 as D1? Yes. Which area has been given? Cumulative area till left infinity has been given. Which means for the area of 0.5033. I have been given 0.6928 area, a small point of learning. Suppose Z is this, positive. If I have been given this area, then what do you do? Sir, 1 minus the given area will give me the area till left tail. Hello? 1 minus the right area will give me the area till left tail. In our case, we have fortunately been given directly the needed area. So ND1 is 0.6928. Now talking about D2. D2 is D1 divided by denominator. ND1 has nothing to do with the D2. ND1 has nothing to do. It is D1 minus the denominator. 0.5033 D1 minus sigma and under root of time, which is 3 by 12. Give you D2 of 0.3933. Have we been given the Z value? Yes. Area till left tail is 0.6529. Now the value directly. 415 spot price given in the question, 415 spot price into ND1, which is 0.6928, already calculated. Present value of exercise price 400 divided by 5% for 3 by 12 into ND2. When you solve this particular thing where e raised to RT's value 0.05 into 3 divided by 12 is 0.0125 has been given to us. Value of e raised to RT has been given to us. So this give you the present value as 29 point, people in the class, 29.60. Yes, that's how you do the valuation using binomial model. This was part number A. This was part number A of this question. Similar easy part you can consider to do at your own, easy things. The last part has dividend of rupee 10 received after 2 months. You will discount that dividend, bring it to 0. Deduct it from the spot price, whatever is the given spot price, and then solve the same question again. That was one question on Black-Scholes model, and that is all on derivatives. The second part of this chapter, people in the class, is interest rate risk management, which I feel that there should be a separate video, because there are a lot of students who want to particularly watch only interest rate risk management. Yes. So in our class, in this revision video, we in the best possible manner covered the entire topic of derivatives, the practical portion of entire topic of derivatives, right? And its practical questions. Yes, two things. First, there are more such revision lectures. I will attach the link to the playlist here in the description. Second, one more topic is there which is called as real options, which is in the study material there in the derivatives only. But in our curriculum, in our class, we cover it in the advanced capital budgeting decision because it is linked to the capital budgeting decisions more. So when you revise the advanced capital budgeting decision, that is where you will cover the real options. Yes. So that was all. Everyone in the class, a small request from my side. If you have really liked the video, kindly liked matlab, if you have by your feelings like that, right, kindly consider putting your comment in the comment section. It motivates me, it helps a new student to gain trust if the video is really helpful or not. This is my small expectation that I have from you all. That was all for the day, a 5-hour video on the topic of derivatives. So let's meet back again in the next class where we gonna complete or talk or discuss either forex or interest rate risk management, any of these two. Yes, thank you so much everyone. Let's meet back again. Till then, bye bye, see you all, take care, bye people. Dhananjay, interest rate risk management mostly day after tomorrow. Okay. So see you. Bye. Take care.